Explain two ethical issues that need to be adhered to in the marketing of Islamic products and services. Gaspard, in answering the question, says one ethical issue is not to invest in forbidden activities. Evelia says do not market certain entertainment secular products such as blue films. Abraham Ayom says Sharia compliance. Abraham, you have to be specific. Which part of Sharia? Vincent says prohibition, usually riba, prohibition. DML says do not invest in interest generating business. Ethical, is that an ethical issue or is just a principle? Gambling, speculations are prohibited under Sharia law. Explain two ethical issues that need to be adhered to in the marketing of Islamic products and services. Gaspard, in answering the question, says one ethical issue is not to invest in forbidden activities. Evelia says do not market certain entertainment secular products such as blue films. Abraham Ayom says Sharia compliance. Abraham, you have to be specific. Which part of Sharia? Vincent says prohibition, usually riba, prohibition. DML says do not invest in interest generating business. Ethical, is that an ethical issue or is just a principle? Gambling, speculations are prohibited under Sharia law. Gambling, speculations are prohibited under Sharia law. Now in this question, please underline marketing. Ethical issues in marketing. So some of the answers are correct, some are general, others are not correct. Now, candidates, when addressing ethical issues, whether the issues are in Islam or conventional business, there are some points that must come out when you are answering questions related to ethics. Don't forget to mention points like truthfulness, transparency, respect, fairness and justice, modesty and decency. Those are points related to ethics. So you only need to explain truthfulness, respect, and so on in relation to marketing, because the question is specific. Ethical issues in marketing of Islamic products, all right? Products and services. So how do you now explain, say, for example, truthfulness or transparency? Because Islamic marketing ethics, candidates, prioritizes honesty. It prioritizes full disclosure in promotional activities. And that means avoiding deception or avoiding misleading claims about the product or service. About the product or service. Because the question refers to products or service. You understand? So that is truthfulness. Another ethical issue is transparency. And transparency extends to the terms and conditions of the transaction, which ensures that consumers have all the information they need to make informed decisions. And that should even cut across, not only in Islamic marketing. When marketing, one is required to be transparent. You don't, for example, sell a product while you are marketing, giving the ingredients that are not available in that product. That is not being transparent. If you are selling a product and it does not have a certain ingredient, then you need to indicate that ingredient B is not included in this product or service. That is an ethical issue. Transparency, right? The third ethical issue is respect for consumer autonomy. Respect is an ethical issue. Islamic marketing ethics emphasizes the importance of respecting the consumer's freedom to choose. Autonomy means independence. Freedom to do what? To choose. And that means avoiding any form of coercion or undue influence, such as high pressure sales. We have some tactics that businessmen use, like high pressure sales tactics. Others exploit vulnerabilities. And that is to mean or to say that consumers should be presented with clear information which allows them to make their own choices based on their needs and values. When marketing products, that is very important. Give consumers information about the product, then allow them to make their own choice. That is consumer autonomy, consumer independence, and it's an ethical issue. You understand? So when answering these questions, make sure you be specific, because the question is specific. Your points should be related to marketing. Another ethical issue in marketing Islamic products is fairness. Fairness. Islamic marketing ethics promotes fairness and justice in all aspects of the transaction, including pricing, distribution, customer service, and so on. And that means avoiding any form of exploitation or any form of discrimination, which then ensures that all consumers are treated equally. All consumers are treated with respect. And fairness also extends to the suppliers and other stakeholders involved in the production and marketing of Islamic products and services. So you see, fairness, justice. Someone talked about interest, gambling, prohibition under Sharia law. Okay. Prohibition. When explaining prohibition in Islam, you've heard of the term haram. Islamic marketing ethics prohibits marketing of products or services that are considered haram or forbidden. And that may include, someone talked about blue films. We have products like alcohol, pork. Someone talked about gambling. That is correct. Gambling. As well as services that involve usury, okay, or exploitation. So candidates, those are some of the points. You are only required to provide 2. I've given you 6. You can add things like modesty, principles like decency. Modesty and decency is also an ethical issue in marketing, in Islamic products and services. Islamic marketing ethics emphasizes modesty and decency in all forms of advertising and promotion. And that means avoiding any images or messages that are sexually suggestive, messages that are offensive, or messages that are disrespectful to Islamic values. So that is April 2024 question 5A. Let's move on to question 5B. Question 5B. The managing directors of 3 profitable listed companies summarize their company's dividend policies as follows. Company A has deliberately paid no dividends for the last 5 years. Company B always pays a low dividend per share after adjusting for the general price index and offer regular bonus issues. Company C always pays a dividend of 5% of earnings after taxation. Each managing director is convinced that his company dividend policy is maximizing shareholders' wealth. Required: identify the dividend theory applied by each of the 3 companies. Identify the dividend theory applied by each of the 3 companies. What is your take? Company A, what is your view? Company A has deliberately paid no dividends for the last 5 years. What do you think? Evaluator says non-relevant. Non-relevant, more MM. Modigliani Miller. Dividend. Is it relevant? Non-relevant. Yes. Relevant. Dividend irrelevant. Non-relevant is the same as irrelevant. Dividend irrelevance theory. Why would a company deliberately refuse to pay dividends for 5 years? Yet we know that people invest so that they can earn dividends, but this company is not paying dividends. Evaluator says company A relies on investment history and earnings. Yeah, that is true. DML, that is true. It is true. It means that dividends do not add value to a company's stock price, or a company payment of dividends have no impact. Abraham, that is true. That the theory suggests that dividends do not add value to a company's stock price. If dividends do not add value, then what adds value? Abraham says dividends do not add value. Then if dividends do not add value to the stock price, then what adds value? Can you answer that? Evaluator says that company A relies on investment history and earnings, not dividends. DML, in a perfect market, the value of a firm is not affected by its dividend policy. What affects it? If not affected by dividends, then what affects the value of the firm. Evaluator says its earnings over the past 5 years. Investors will only look at the earnings over the past 5 years. So I think most of you got the answer right, that the theory suggests evaluator says investors will only look at the earnings over the past 5 years, that is income statement. Now you are referring to the investors, potential investors, I think, but you need to remember dividends are not paid to potential investors, but they are paid to the existing investors. If the company is not paying dividends, and we know investors buy shares to earn dividends, then what will motivate potential investors to invest in this company yet is not paying dividends? Investment decisions and capital structure affect the value of the firm. Investment decisions and capital structure affect the value of the firm. That is true. Affects the capital structure of the firm. It may be more perfect to say affects the value of the firm, not just the capital structure, but the value of the firm. And by value of the firm, we are referring to the value of a share. Shareholders are interested in the value of their shares. If they are not earning dividends, then the value of the shares should appreciate, and they enjoy what we call capital gain. Capital gain. Evaluator says potential investors will look at how earnings are behaving relative to potential investors. But evaluator, our interest is not on potential investors, but on the current investors. The current investors, they are not being paid dividends. They are not being paid dividends. Your point is true, but we are focusing on the current stockholders. Though they are not paid dividends, they enjoy capital, what we call capital appreciation. Capital appreciation. They enjoy capital appreciation. Capital appreciation. They enjoy capital appreciation. Someone says relies on tax differential theory that dividends are taxed higher than capital gains. It seems you guys have been studying, but talking finance. Someone is talking about tax differential theory, that dividends are taxed higher than capital gains. Now, your answer should be in relation to Modigliani-Miller theory. Modigliani-Miller theory. Your point should be related to because the question is identify the dividend theory applied by each of the three companies. So the dividend theory applied is Modigliani-Miller or theory, and that will earn you the 1 mark. The questions I'm asking are not related to what has been asked here. I'm asking that question because you never know, maybe in your setting you'll be asked the question I'm asking. Here you are required to just state the theory and earn the 1 mark. But I'm asking, what is the rationale behind? In explaining, then your answer should be limited to Modigliani. This theory suggests that in a perfect market, just as one person had indicated, that in a perfect market, a company's dividend policy does not affect its market value or shareholders' wealth or the value of a share. That is to say that shareholders are indifferent to whether they receive returns in form of dividends or capital gains. So you need to understand that when you invest in a company, when you buy shares of a company, as a shareholder, you may enjoy the dividends, which may be paid regularly, or you may enjoy capital gains. That is to say, if you bought a share at 5 shillings, over time, the value of that share may appreciate to 10 shillings, meaning that there is a gain, capital gain of 5 shillings. So Modigliani and Miller argue that in a perfect market, the dividend policy does not affect the value of a share. And you need to understand that the value of a share appreciates based on the forces of demand and supply. The value of a company's share will appreciate if there is high demand for that share. You understand? You understand? So company A's decision to not pay dividends for the last 5 years could be based on the belief that reinvesting profits into the company would lead to higher capital gains for the shareholders, and thereby offsetting the lack of dividends. Because if a company does not pay dividends, then it means that that money is reinvested in the company. And we know retained earnings is one of the cheapest sources of funds. So a company may choose not to pay dividends so that the money that could have been paid in form of dividends can be reinvested in the company at a lower cost, which still benefits the shareholders. You understand? That is company A. Company B always pays a low dividend per share after adjusting for general price index and offer regular bonus issue. The question is, identify the dividend theory applied by this company, company B. Mani says regular plus extra. Company B always pays a low dividend and offer regular bonus issue. Regular bonus issue. Regular bonus issue. Regular plus extra. But we read here, pays a low dividend and offer regular bonus issue. Irene, clientele, residual theory states that a company should prioritize investment opportunities and only pay dividends from the residual earnings after funding all viable projects. Residue, from the word residue. Okay, this company could be applying that theory. Low dividend means that this company had the money to pay, but it's paying low dividends. That means that a big percentage of the earnings must have been used to invest in opportunities. Then what remains is now paid as low dividends. What remains, the residue. Low dividends means that a big portion of the retained earnings is invested. The theory states that a company should prioritize investment opportunities and only pay dividends from the residual earnings after funding all the viable projects. So the low dividend ensures sufficient funds for investment. The low dividend ensures sufficient funds for investment. So the company may pay 70% of the profits, then 30% or 20% is paid in form of dividends. What remains? Residual. So the low dividend ensures sufficient funds for investment, while the bonus issue, because after paying, then there is a bonus. Do you get that? The bonus issue is a reward to the shareholders. Okay, bonus. Because bonus, what is bonus? Bonus are just free shares. The company gives the shareholders free shares. Instead of giving the dividends, they are given free shares. So that compensates the shareholders for the low dividend that has been paid. Low dividends, but there is bonus. Do you understand? Instead of giving all the money in form of dividends, the company reinvests a major portion of the money into viable projects, then later on pays low dividends, then the shareholders are given bonus. Bonus issue reward shareholders by increasing their stake in the company. A bonus issue is free shares. You understand? So the theory here is residual. DML was correct, residual dividend. How about the third company? Company C always pays a dividend of 5% of earnings after taxation. Always. Always pays. Company C always pays a dividend of 5% of earnings after taxation. What do you think? Abraham says regular dividends or constant. Constant. When you say something is constant, what does that mean? Fixed payout ratio. That is correct. Give me another synonym. Stable dividend policy. This is a stable dividend policy. It is fixed dividend policy, fixed payout ratio. All those are answers. And this theory suggests that companies should maintain a consistent dividend payout ratio. Then I'll ask you the question, why do you think that is the reason why companies should maintain a constant dividend payout ratio? What could be the reason behind the theory? Because this theory suggests that companies should maintain, and this company, see, that's what it's doing. It's maintaining dividend of 5% of earnings after taxation. Maintaining, that's a constant, it's fixed. Why do you think it's important that a company maintains a fixed dividend? Someone give me the answer. For predictability. For predictability. DML says for predictability. And that is true. Predictability. It's important if you are for a shareholder to know that this year I'm going to earn, say, 50,000 in dividends constantly, so that the shareholder can also plan. It's predictable. Understand? Maybe a shareholder can use that money for having an annual holiday or something. There are people who would want to have that predictability, stable returns. These are stable returns. provides predictable income to the shareholders and can attract investors seeking stable returns. The investors who may want stable returns. Vincent said for assurance. That is correct. For assurance of shareholders of their return, not investment. Assurance of return on investment. So that is what was required there. That tells me you've been studying. That's quite encouraging because you've answered the question appropriately. Now let's move on to the easier part of the question, because these are ratios, and you see the question is balanced. If you can't get the theories, then calculations, because the theories here are just 7 marks. This question theory 7 marks, the rest 13 marks for the calculations. Part C of the question reads, you are presented with the following information in relation to Furaha Limited for the year ended 31st December 2024. That is the information. Net sales, current liabilities, debt assets ratio, debt turnover based on net sales, debt turnover based on net sales, net profit margin, gross profit margin, inventory turnover ratio, return on total assets, fixed asset turnover, corporation tax rates required, Roman 1, cost of sales, receivables, net profit, closing inventory, total assets and current assets, long-term debt, 1 mark each. D, prepare a forecasted statement of profit or loss and statement of financial position for the year ended 31st December 2024 based on your results in C1 to C7 above. Cost of sales. Roman 1, this is C Roman 1, cost of sales. This was an easy one, isn't it? Cost of sales. So candidates were to use the ratios to determine cost of sales and the rest of the items there. So you just go to the ratios and identify which ratios relate to cost of sales. And you can see we have the net sales. Net sales. We have the net sales. Okay? And we know candidates that out from your accounting knowledge, cost of sales is equal to sales minus gross profit. Is that true? Okay. In your accounting, when preparing the trading profit and loss account, we always have sales less cost of sales. Then we have here the gross profit. Sales is equal to cost of sales, then will be sales minus gross profit. So you use the ratios that are given to determine the cost of sales. Cost of sales. Now let me give you an opportunity before I do it, because it's just 1 mark. What do you think? What is the cost of sales there? Evelia says 2,250. 2,250. 2,250. Which ratio did you use, Evelia, to determine the cost of sales, GPM, gross profit margin, gross profit margin, gross profit margin. The gross profit margin is given. The gross profit margin is given 25%. If you have the gross profit margin at 25%, then that can help you determine, because you have the gross profit margin, gross profit margin. We know that gross profit is equal to the gross profit margin times sales. In this case, you have the net sales. So the gross profit will be equal to the 25% times sales of the 3 million. 3 million. So that is the gross profit. That will give you the gross profit. And you've seen that sales, cost of sales, we are calculating cost of sales. Cost of sales, from this we know cost of sales is equal to sales minus gross profit. Sales 3 million. What is the gross profit? 25% of 3 million. 25% of 3 million. 750. Vincent says 750. This is 750,000. Will be 750,000. 750,000 is equal to 2. Someone had gotten it. What was it? Evalia? Yes. 50. That is the answer. That's the cost of sales. 2,250,000. Correct? The second item is receivables or debtors. Which ratio are we going to use to calculate debtors, and what information have we been given? So that is what you do. Receivables. Now, candidates, when you are required to determine receivables, what you do, you check from the information given which ratio is related to receivables. And you can see there we have debtors turnover. And Abraham says receivables is equal to annual credit over average debtors. Is that true? Receivables already is the same as debtors. Debtors turnover based on net sales. Net sales means that the meaning of net sales is that the returns are being deducted. So that's the meaning of net sales. So we have the debtors turnover ratio of 2. Debtors turnover ratio of 2. And we know that debtors or receivables is equal to credit sales over average debtors. Is this true? That receivables is equal to it is supposed to be the ratio, the data's turnover ratio, the data's turnover ratio data's turnover ratio is equal to credit sales over average debtors. Did I see that here? Abraham has said that receivables is equal to annual credit sales over average debtors. So it was supposed to be the ratio is equal to that. So candidates, are you following? If you are given the ratio, which is known, it is 2. Then you need to put down first of all the formula for that ratio. That should be the starting point. Then you can substitute the known values, then determine the unknown value. This average debtors is what we are looking for. This is the unknown because we have credit sales and we have the debtors turnover. So what is this unknown? So there are various ways of going about it. You can decide to make these average debtors the subject of the formula by equating, because we have debtors turnover ratio, making this a subject of the formula, we'll have debtors turnover ratio cross multiply. You cross multiply. The debtors turnover ratio times average debtors is equal to credit sales. I'm taking it slowly so that you get it once and for all. You want to make average debtors the subject of the formula because we have 2 unknowns. So we are going to divide both sides by the debtors turnover ratio. Both sides debtors turnover ratio. So this will cancel out with that. And therefore the average debtors will be equal to credit sales, which we have, the 3 million. We divide the ratio, which we have, 2. And this is equal to 15. Is that correct? Did you get that? Someone got the wrong or the right answer? Am I on the right track? No one attempted it. So that is the value for debtors. Do you understand? Do you understand? I want you to understand. I don't want you to memorize. I want you to understand. When you are given a ratio, as is the case here, that is will help you find the receivables, this step is very important. You don't need to memorize every formula as long as you know that debtors turnover ratio, because the question is about ratios. The debtors turnover ratio, we know even from financial accounting knowledge, is equal to credit sales over average debtors. In this question, you've been given the credit sales, you are given the ratio. So how do you determine average debtors? You make average debtors the subject of the formula. Okay? Yes, you can move. That is correct. 3 million DML, we have it in the question. net sales 3 million. Those are credit sales. Unless told otherwise, that is the assumption. Then the next item is net profit. Net profit. Net profit. This is number 2. Number 3, net profit. Net profit. You look for any data relating to net profit. And we have it right there, net profit margin. Net profit margin is 5%. Our net profit margin is always applied on the sales. So you have net profit we know is equal to net profit margin times sales, which is equal to 5% times the sales, 3 million. That true? That one was direct. See, in the exam you cannot fail to get some marks. That's it. How much is it? 5% of 3 million? 150,000. So 150,000. It was that simple, right? Closing inventory. Closing inventory. Closing inventory. Look at the ratios. Which information relates? Which ratio is related to closing inventory? That one you don't need to think much. You just look at the information, which one reads inventory. And we have it down there, inventory turnover ratio. Inventory turnover ratio, you've identified it. That one is known. Inventory turnover ratio. So number 3, inventory turnover ratio. What is the formula for inventory turnover ratio? That's the next thing you need to do. And before you get to the exam, all these ratios, the formulas, you must memorize. And it's a time for you to memorize. Turnover. Inventory turnover. What is being turned over? It is the inventory. That means inventory is sold. How many times is inventory sold and bought throughout the year? You buy, you sell. That means you've turned it once. Then you buy, then sell. You've turned it over twice. That means turning inventory into sales. You are turning inventory into sales. So without memorizing, you need to know. Because this one was data's turnover. You see, these data are turned into sales. So what is the formula for inventory turnover? Abraham, net profit after tax is always divided by net sales. Yes, then you multiply by 100 to get the net profit margin. Vincent says cost of sales over average inventory is equal to cost of sales over average inventory. Average inventory. Is that true? Inventory turnover, cost of sales over average inventory. So do we have average inventory? Do we have average inventory? The ratio, we have it. This ratio, we have it. We are looking for inventory. Do we have the cost of sales? Yes, we calculated cost of sales here. That's the cost of sales. So we can do it the same way we did the other one. Make average inventory the subject of the formula. Cross multiply inventory turnover ratio, cross multiply, times average inventory times average inventory is equal to cost of sales times 1. Cost of sales times 1 is equal to cost of sales times 1. Cost of sales times 1. Divide both sides by the inventory turnover ratio. Inventory turnover ratio. This will cancel out with that. Then you remain here with average inventory. Inventory is equal to cost of sales over inventory turnover. So you see, once you know one formula, then you can easily make the other inputs the subject of the formula. So we have seen that average inventory, which is the question, average inventory, that's the question, inventory. Inventory is equal to cost of sales over inventory turnover. Cost of sales, we have it 2250000. The turnover ratio 1.25. That will give us the inventory. How much is it? Kevin says 1.8 million. 1.8 million. 1.8 million. That is the inventory. Then we move on to calculate total assets. Total assets. What ratio is related to total assets? Look at the table. We have debt asset ratio. Yes, debt asset ratio of 0.6. The debt asset ratio. We know that the debt asset, these are two things, debt and asset, is equal to total debt divide by total assets. Candidates, do you really need to memorize this? You are asked to note down the debt asset ratio, and you are given the items debt and asset. So the formula is total debt over total assets. Debt over asset. That is the formula for debt asset ratio. So then you check for information given. Do you have total debt? Do you have total assets? Do you have total debt? Do you have total assets? Do you have the total debt? You have total assets. We have debt asset ratio. We have the debt asset ratio. Okay. We have to identify, we have to calculate the total assets. So again, we make total asset the subject of the formula. And we're just going to divide this by 1. Debt asset ratio is equal to times cross multiply. You cross multiply. Debt asset ratio times total asset is equal to total debt. Divide both sides by the debt asset ratio. This will cancel out. Okay, so you have total assets is equal to total debt over debt asset ratio. So the question is total assets. So total assets is equal to total debt over that true. What are you calculating? Yeah, total assets is equal to total debt over the debt asset ratio. Debt asset ratio. But we needed to determine the right Any question? Olivia says, I'm catching up, but have understood the debt-asset ratio. You understood the debt-asset ratio. Chumba says that following, but I can't find the figure in the question paper. So let me take it again. We are required to calculate total assets. Let me take it again. You understood that bit, but which ratio are we supposed to use? Which ratio are we required to use to calculate the total assets? I picked debt asset ratio, but you can see if you pick debt asset ratio, there are two missing figures. You just check from the question which ratio is related to assets, and the third last ratio you see there is return on total assets. We are given return on total assets because we are required to calculate the assets. Are we together? Total assets. If we are to calculate total assets, then which ratio do we use? We are supposed to use the ratio related to total assets, and it's the return on total assets. Return on total assets. You are given the ratio return on total assets. So what is the formula for return on total assets? That's the second question. Olivia says we are to use the total debt. We have the CL. Return on total assets, candidates. Return on total assets, definitely that will be the return over total assets. You don't need to memorize this one. The return on total assets is equal to return, which in our context is a net profit. That not so? Over total assets, which we do not have. We are required to calculate the total assets. So we make total assets the subject of the formula by cross multiplying. we cross multiply so that we have return on total assets times total assets being equal to return, which is a net profit. Okay, we want to calculate the total assets. So we divide both sides by return on total assets over return on total assets. This will cancel out. So we'll have here total assets is equal to net profit over return on total assets. Is that okay? Are you understanding? Understanding? Are you understanding? Do you understand? So we are to calculate the total assets. And you've seen that total assets will be equal to the net profit divided by return on total assets. So we have the net profit. I think we calculated it. Net profit. It's 150. Is that clear? Vincent says return net income divided by average total assets. It's not average, it's just total assets. Assets are not averaged. It's just equal to net asset, not net income divided by the total assets. And we had the return. So we have it 150,000. And what is the return? From the question, the return is return on total assets is a percentage. It's 2%, and you need to be very keen here. This 2%, if you are dividing here, then you have to convert it into decimal 0.02. Because if you are to just put 2 here, you get the wrong answer. It ought to be 0.02, which is equal to, do you understand? This is given as a percentage. When dividing, you convert the percentage into decimal to get the total assets. How much? How much is, Abraham says 750. Is it 750? Are you sure it's 750? Vincent says, make sure, Abraham, you check the decimal. It's supposed to be 0.02. The reason why you are getting 750 is because you've ignored 7.5 million. Is that true? 7.5 million. 7.5 million. That is the total asset. We've done the total assets. Yes. Correct, Abraham. 7.5 million. Roman, this is number 5. 6. Net. This is non-current assets. You have to calculate the non-current assets. From the question, which information relates to non-current assets? Which ratio relates to non-current assets? Evelia says the fixed asset turnover. Fixed asset turnover. Fixed asset turnover. Fixed assets turnover. Is it fixed assets turnover? Yes. Fixed assets. The non-current assets are fixed assets. That is correct. So, what is the formula for? What is the formula for fixed assets turnover. You begin with the known. The known, we know that the fixed asset turnover will be equal to, I think someone has said, is it credit sales? We divide by the fixed assets. Anytime you see turnover, just understand they are referring to sales. Turnover refers to sales. Okay? That is the formula. Fixed assets turnover. Is that true? Someone says net sales over average fixed assets. Why do you say average? What is being averaged? DML is just fixed assets, not average. Average is related to inventories and receivables. And where the two are not given, that is opening and closing, you use the closing. So we have this fixed asset turnover, we have the credit sales, we do not have the fixed assets. So you make fixed assets the subject of the formula by cross multiplying. You cross multiply. That will be fixed asset turnover times fixed assets will be equal to credit sales. So we divide both sides by the fixed asset turnover. Divide here with fixed asset turnover. This will cancel out. So the fixed assets will be equal to credit sales over fixed asset turnover. So fixed assets or non-current assets, fixed assets or non-current assets, fixed assets. The formula is credit sales we divide by fixed asset turnover, which is equal to the credit sales is 3 million. Divide by the turnover. What is the turnover? Fixed asset turnover 0.8. That will give us the amount for fixed assets. The amount for fixed assets. How much is it? Have you done the calculation? How much is it? 3.75 million. 3.75 million is the value for non-current assets. That is just one mark. One mark. Then you have long-term debt. Long-term debt. Which formula do we use? Long-term debt. Long-term debt. Long-term debt. There is a debt asset ratio. Debt asset ratio. We use the debt asset ratio, correct? Debt asset ratio. The debt asset ratio. We use the debt asset ratio. Debt asset ratio. And we know the formula. Debt asset ratio is equal to debt, total debt over total assets. Is that true? Is equal to total debt over total asset. You don't need to think. You are given the ratio. debt asset. So the formula is debt over asset, and you are dealing with the totals. So if debt asset ratio is equal to total debt over total asset, then what will be the total debt? Make total debt the subject of the formula by cross multiplying. Debt asset ratio times total asset is equal to total debt. That's what we are looking for. We are looking for the debt. Huh? We need to calculate the debt. Debt asset ratio is equal to total debt over asset. We want to make debt the subject of the formula. Is that correct? So total debt is equal to debt asset ratio times total asset. That's correct? So that is how to make total debt the subject of the formula. Total debt is equal to total assets times the debt asset ratio. We have the total assets. We have the total assets. These are fixed assets. So total assets will be equal to the fixed assets plus current assets. But we have current assets. No, we have current liabilities. So where do we get the total? Where do we get the total current assets? Because we are dealing with the totals. We need this total asset. Where do we get the figure for the total asset? Someone? Yeah, we have the total assets, 7.5. Total assets we had calculated total assets 7.5. Yeah, we calculated total assets. Yes, total assets. Sometimes you may not be given the total assets. Right? This question was simple. We needed there are times when you may need to calculate the total assets. Now, when you are required to calculate the total asset, then understand to get total assets, you add liabilities to the fixed assets. So the total assets this is 7.5 million times the debt asset ratio. The debt asset ratio is 0.6. 0.6. So how much is the total debt? How much is the total debt? 0. Someone say 0.8. Fixed assets. Is it 0.6? Oh, it's 0.6. So what's the total? 4.5 million. 4.5 million is the total debt. That is 1 mark. 1 mark. 1 mark. 1 mark. You are presented with the following information in relation to Furaha Limited for the year ended 31st December 2024. That is the information. Net sales, current liabilities, debt assets ratio, debt turnover based on net sales, debtors turnover based on net sales, net profit margin, gross profit margin, inventory turnover ratio, return on total assets, fixed asset turnover, corporation tax rates, required, Roman 1, cost of sales, receivables, net profit, closing inventory, total assets and current assets, long-term debt, 1 mark each. D, prepare a forecasted statement of profit or loss and statement of financial position for the year ended 31st December 2024 based on your results in C1 to C7 above. Cost of sales. So those are two statements. And we are to use the results in C1 to C7 above. So we can begin with forecasted profit and loss account. So we have to write the name of the company. The company's name is Furaha Limited. Furaha Limited. Statement of forecasted profit or loss for the year ended 31st December. So this is the income statement, and we begin with the sales, which we have there, net sales. We'll have the net sales. We'll have the cost of sales. That is the formula. Then we'll have the deduct cost of sales. That will give us a gross profit. Then we have the expenses. Do you have expenses? No, we don't have expenses. There are no expenses. So we have expenses, unknown, will be deducted from that to give us the net profit. Then after the net profit, this question, do we have the tax? We have the tax. I'm laying down the formula first, or the approach. Then we'll insert the knowns. Then we'll work out the unknowns. So this is how you prepare an income statement. You take sales, deduct cost of sales, get the profit, deduct expenses from the gross profit, then you have the net profit. Then if there is tax, then you tax. Do you have tax? Yes, corporation tax. Corporation tax. Corporation tax down there is at 30%. 30% of the net profit will be deducted. Then we'll have earnings after tax. Earnings after, or profit after tax. We'll have the profit after tax. Okay, so this is profit, net profit, or profit before tax. Before tax. Profit before tax, deduct the tax, then you have profit after tax. So are we on the same page? Tax is 50%, not 30. 50%, correct? Tax is 50%. 50%, yes, 50%. So that should be the starting point. When you are doing such a question, first of all, you don't have to put the excess, but you can use it as a working to guide you so that you know what is given and what is not given. So here, these are shillings. Sales 3 million. Cost of sales we calculated here. Cost of sales 2 point this is 3 million. Cost of sales 2.25 million. We deduct the gross profit is 750. All this we know. 750,000 is a gross profit, right? Gross profit. Then expenses is unknown. Expenses, do we have anything in relation to expenses? No, we do not have. Do we have net profit before tax? Yes, it was 5% of the sales net profit. We calculated net profit here. Where is it? That is the net profit. The net profit. The net profit. We have corporation tax. Are we together? Is tax an expense? Someone is asking if tax is an expense. Tax is a deduction. Okay, we are moving on well. The net profit before tax, this one here, we do not have expenses, but we have net profit before tax, 150. Is that clear? Net profit before tax is 150. We calculated it here. Are you following? Israel sales, yes. Are you moving on here? Okay, was confused. I've noted earnings before tax. So we have sales less cost of sales, gross profit, expenses, earnings before tax. Earnings before tax. Earnings before tax. So this one is earnings before tax. This profit should be here. The profit. This is gross profit. Deduct expenses. Gross profit. This is gross profit, which is not sales minus cost of sales gives us the gross profit. Then we deduct the expenses. We deduct the expenses to get the net profit before tax. Okay, net profit before tax. Then we deduct the corporation tax. So are we moving on well? So tax will be, Abraham says, so tax will be 50% of 150. Abraham, come slowly, Abraham. But it's good you're asking questions. You're asking if tax will be 50% of 150. So the net profit, candidates, we have the net profit before tax. Are we following? Is the format clear? We have the sales from our workings. We have cost of sales from our workings. Cost of sales deducted from sales gives us the gross profit. From gross profit, we require to deduct expenses, which we do not have. Then after deducting expenses, we have the profit. Okay, is that clear? We have the profit. Yes, Maggie says, is it right to say our expenses is 600,000? Is it right to say our expenses is 600,000? How did you arrive at 600,000? Maggie, how do you get the figure of 600,000? Maggie says, we already have net profit of 150 before tax. That net profit of 150, it is not net profit before tax. That is the final profit. That is after tax. After tax is 150. Earnings after tax. This earnings after tax, Maggie, is the 150. That is the profit after tax. Earnings after tax is 150. It's not before, it's after. Earnings after tax is the 150. So, and this is where you need to be keen, because we are required to work backwards. Corporation tax, we are given a percentage. Okay? The expenses are not known. We do not know the expenses. So someone had asked, 50% of X is equal to 150. What is X? Vincent, what is X? There are many ways of doing it, and I don't want to impose my way. Let's try Vincent's approach. In Vincent says that 50% of X is equal to 150. Let me try that. It says that 50% times X is equal to 150. So he's asking, what is X? It's very simple. It will be 50% X is equal to 150. This is mathematics. And this can be converted into decimal. This will be 0.5x is equal to 150. And therefore x is equal to 150. That's what you're asking? Over 0.5. How much is it? That would be, is it 300? Yes, 300. There are many ways of doing it. This is not the way I would do it. Okay, that is 300,000. So what is x? What is this x? Vincent, what is the x? What is that x? EBIT, earnings before tax. Yeah, earnings before tax. The earnings before tax will be 300,000. That is correct. Now, if earnings before tax is 300,000, then what will be the expenses here? What do you deduct here from 750 to get 300? Is it not 450? You work backwards. Okay. And if earnings before tax is 300,000 and the corporation tax is 50% of this X, is it? Then our tax will be 50% times 300, which is equal to 150. That is one way. There are many ways of determining it. For example, if you are given 150 as the earnings after tax, if 150 is earning after tax and the tax is 50%, because earnings the profit to get this to earnings after tax plus tax should give us earnings before tax. So if this one is 50%, if tax is 50% and is 50% of that, then that tells you that the two are the same, 50%. This is 50% and this one is 50%, which will be equal to the 300. If these two are the same, 50%, 50%, and this one is 300, then it's obvious that this should be 150 plus 150 to give you the 300. So you work it backwards. And this is common with such questions that deal with ratios. So we've done the income statement. We need to move to the last part of this question, that is a statement of financial position. Statement of financial position. Furaha Limited. Furaha Limited statement of financial position as at December 2024. December 2024. And by the way, this is only 3 marks, is it not? Yeah, just 3 marks. Then we move on to the statement of financial position. And we are using the values we calculated in Roman 1 to Roman 7. We begin with the fixed assets. Do you have fixed assets? In fact, we have total assets. We don't need, we have total assets. So we have fixed assets. Let's do it. Fixed assets, current assets, total assets. That will give us the total assets. That plus that will give us the total assets. These assets are financed by assets and liabilities. Equity. Do you have equity? Equity. Yes, you have debt assets ratio, inventory ratio. So how much is the fixed assets? Someone? Fixed assets? Fixed assets. If you messed up in the financial ratios, does it mean you literally score 0 in this statement? Yes, you score a clean 0. Clean 1. In fact, when you get it wrong when marking, when the ratios are wrong, the examiner may not have time to look at the statements. May not have that time because the question says that prepare a forecasted statement of profit or loss account based on your results in C1 to C7 above. If C1 to C7 above, there is no time for the one who is marking to consider all that. You score not just 0, but clean 1, a clean 0. All right, that is the answer to that question, DML. Does it mean that you score a 0? You score zeros, not 1. You score 0 in the income statement, 0 in the okay. So Evelia says fixed assets 3.5. Have you calculated? 3.5. Yes, fixed assets 3.5. That's correct. 35. Is it 3.7750? Current assets. Value for current assets. Someone, please. Current assets. Yes, 3.75. 375. Now, if you have the total assets, these are the total assets. And total assets is equal to fixed assets plus current assets. Then the current assets will be equal to the total assets minus fixed assets, which is equal to 3,700,000. These are total assets. Financed by. These assets are financed by what? What finances these assets? Financed by financed by I'm waiting. Financed by assets must be financed by, of course, equity. Assets are financed by equity, then they are financed by liabilities. Do we have equity and liabilities? There are no equity. There is no equity from our workings. We didn't calculate equity anywhere here. But from the question, you can see we have debt. There is debt asset ratio. Then there is current liabilities, assets and liabilities. So do we have long-term debt? But I can see we have current liabilities. 15. This is 7.5. 15. This one is directly from the question. So what is the value for these two? Equity. How do we calculate equity? We have long-term debt. Yes, we have long-term debt here, 4.5. We have long-term debt from the question. Here it is. How about equity? Do you have equity? Equity. How do you determine equity? As a balancing figure? Yes, as a balancing figure. We know that accounting equation, assets is equal to liabilities plus capital. So if you have this total, 7.5, and you have these two, this is 6 liabilities. We have, this is 6 million. This is 7.5 and this is 6 million. The balancing figure will be 1.5. Do you understand? This is calculated based on the accounting equation. Assets equal liabilities plus capital. We have the assets, we have the liabilities, so equity is equal to 1.5, which should give us 7.5. This is total equity and liabilities. Total equity and liabilities. Assets, total assets is equal to total equity and liabilities. 1, 2, 3, 4, 5, 6. So each entry is just half a mark. This one, someone had asked, if you do not separate these two, do you lose marks? You don't lose marks. This one is just 1 mark. 3 marks. Someone had asked, if you got this items wrong, do you score nothing? Yes, you will score nothing, but you may get some marks, like the current liabilities, because this one's direct from the question. That's why it's not easy to score 0 in this exam. It's not easy to score 0 because like current liabilities didn't need any working. Okay, at least this one you can score a half a mark because each entry is just half a mark to earn the 3 marks. So you can earn at least half a mark in that statement. Then let's see, is there any free marks here? Yeah, we have sales from the question, another half a mark. So at least it's not, as I'm saying, it's not easy to score 0. There are some free marks like these ones. So is there any question? Any query? And I told you, when to avoid getting wrong answers, you saw what I did. I was making each item the subject of the formula so that you don't mistake. I didn't do it for any other reason but to help you understand. If you want to get these items, this is not the last figure. I had a working where I made total asset the subject of the formula. When you do that, you reduce the chances of getting wrong answers. Any question? This was in the last sitting. Will it come again in August sitting? Yes, it will come again in another form that you've never seen before. It will come again in a strange form, but the concept remains the same. If you want to answer this question, make sure you have at least memorized this formula. Whichever manner the question is tested, this is one of the easiest questions because it does not need much thinking. You only need to memorize the formula. And this formula to memorize is easy. All right? It is straightforward. Any other question? It will be tested again. It will be tested. But it will not be the exact question. If you see the word turnover, know you are using sales figure. Yes. And know that whatever is being combined with that sales, it's being turned over. If it is debtors turnover, it is asking you to calculate how many number of times can the debtors be converted into sales. If it is inventory, you are to calculate the number of times the inventories are turned over into sales. That means you buy, sell, that is once. You turn over once. Then after buying, then you sell again, you're turning it over. All right? That is the essence. So these ratios, you can get the formula from even the wording. When you read total assets, return on total assets, return on total assets. Return is a profit. It is just profit times the total assets. Return on total assets. The return on total assets. Okay. Any other question? We are tackling April 2024, December 2023, August 2023, April 2023. Download the past papers, have them in hard copy. When we meet, you join in. So thank you for joining today's lesson. In case of any updates, we will always communicate on WhatsApp. Bye bye. Candidates, welcome to the lesson. For those of you who are joining For the first time, we have been answering questions from the April 2024 sitting. So far, we've done question 1 and question 2. Today, we're going to answer question 3. Question 3. It's my hope you have the question papers which we had shared in the WhatsApp group. Make sure you print the papers if you have not printed, so that when you appear in these lessons, have the hard copy. Okay. Now let's begin. Question 3A. Explain the following option trading strategies. Explain the following option trading strategies. Roman 1, bull spread. Roman 2, bear spread. Roman 3, covered call. Covered call. 2 marks each. Now these were brief questions on option trading strategies. The first one is bull spread. Bull spread. Now, before we explain the bull spread, first of all, what is a bullish market or a bullish investor, and who is a bearish investor? That by understanding first of all a bullish investor, we will be able to easily understand the bull spread. Now, first of all, in the context of financial markets, bullish refers to an investor or a market sentiment that expects prices to rise, and therefore a bullish investor is optimistic. A bullish investor is optimistic about the future performance of a particular share or stock or market or asset class. They believe that prices will rise and are likely to buy or hold on to assets in anticipation of gains in future. That is a bullish investor. Is one who expects that the prices will rise in future, and therefore is likely to hold on to an asset, hoping that when the prices increase in future, is likely to gain. Now, having understood a bullish investor, then what's the meaning of bull spread? Now, bull spread, as the question suggests here, is an option trading strategy. Okay? Bull spread is an option trading strategy. All right? First of all, it is an option trading strategy, and is used when an investor expects a moderate rise in the prices of the underlying asset, and it involves buying and selling 2 options of the same type, but with different strike prices. So that is a meaning of bull spread. Then Roman 2, we have the bear spread. The bear spread. Now, to understand the bear spread, we ought first of all to understand a bearish investor. A bearish investor. Now, bearish is the opposite of bullish. It is the opposite of bullish. You recall we say that a bullish investor is one who is optimistic about future performance of a particular stock or asset. But we are now saying a bearish investor is the opposite of bullish. And bearish refers to a negative or pessimistic outlook on the future performance of a particular stock market or asset class. So a bearish investor believes that prices will decline and is likely to sell or avoid buying such an asset in anticipation of such losses. That is a bearish investor. And therefore, what is a bear spread? Now, a bear spread is just like a bull spread. It is an option strategy that is used when an investor expects a moderate decline in the prices of an underlying asset. And it involves buying and selling two options. And the two options are of the same type. Do you understand? That's the meaning of bear spread. Then Roman 3, we have covered call. Now, a covered call is also an option trading strategy where an investor holds a long position in an asset and sells call options on that same asset in order to generate income from the option premiums. And that strategy is used when the investor expects the underlying asset to have very little or no price increase. That is the covered call. That is the covered call. Now, that is part A of the question, 2 marks each. Duet Limited is considering a takeover bid for Small Limited, another company in the same industry. Small Limited is expected to have earnings next year of 129 million shillings. If Duet Limited acquires Small Limited, the expected results from Small Limited will be as follows. So we have 3 years expected results: sales, cost, cash costs, capital allowances, interest charges. We have cash flows to replace assets and finance growth. Additional information number 1. From year 4 onwards, from the 4th year onwards, it is expected that the annual cash flows from Small Limited will increase by 4% each year in perpetuity. Number 2, tax is payable at the rate of 30%. Tax is paid in the same year it falls due. 3, if Duet Limited acquires Small Limited, it estimates that gearing after the acquisition will be 35%, measured as the value of its debt capital as a proportion of total equity plus debt. 4, the cost of debt is 7.4% before tax. Duet Limited has an equity beta of 1.6. 5, the risk-free rate of return is 6% and the return on the market portfolio is 11%. Required. Roman 1. The offer price for Small Limited, assuming Duet Limited chooses to value Small Limited on a forward price earnings multiple of 8 times, 2 marks. Roman 2, the cost of capital of Duet Limited, 4 marks. Roman 3, determine the offer price for Small Limited using discounted free cash flows valuation method. That is the question. All right, 8 marks. Now this one was relatively the easiest question in this sitting. It was relatively the easiest because question is direct. It's very direct. Look at Roman 1. The offer price for small limited, offer price. Assuming Duet chooses to value small limited on a forward price earnings, right? That is the PE multiple of 8 times. Now that means that Duet Limited is considering buying small limited and is issuing or using evaluation method based on the forward price to earnings ratio. Forward price to earning ratio. This is only 2 marks. I'm just taking time to explain, help you understand the question. But the answer is very simple. We just take 8, then multiply by the earnings of this company. It will be 129 million times 8. That is the answer. But I'm taking time to explain so that you understand that the forward price to earning ratio is a method that is used when valuing targets. Okay? The Duet is going to use evaluation method based on the forward price to earnings ratio, and the candidates in valuing the target, the company estimates a company's value by looking at its predicted future earnings. That's why in the first sentence we read that this company is expected to have earnings next year of 129 million. You understand? So this is the answer. This is a Roman 1. The offer price will be equal to earnings of the target times the PE ratio. And the earnings of the target, from the first sentence, we get the earnings of the target, 129 million. So 129 million times the ratio. The PE ratio is 8. The multiple is 8 times 8. And that is the answer. 2 marks. We just picked it directly. A forward price earnings multiple of 8 times. So how much is it? 1032. That is 1 billion. 32 million. 1032. 1 billion. 32 million. 1 billion and 32 million. Yes. Agostino, that is correct. Kelvin, that is correct. So that is the answer, 2 marks. Roman 2, the cost of capital. The cost of capital, Roman 2. So when you have such a question, step number 1, put down the formula. Cost of capital Roman 2. We are to calculate the cost of capital. Now, this is a geared firm. It is a geared firm. And in Roman 3, we read that if Duet acquires Small Limited, it estimates that the gearing after acquisition will be 35%. So the proportion for debt will be 35%. Okay, which means the proportion for equity will be 1 minus 35%. So this is a geared firm, and therefore we have to calculate the weighted average cost of capital. The cost of capital of a geared firm is the weighted average cost of capital. The weighted average cost of capital, which is equal to the weight of equity, weight times cost of equity, plus weight of debt times KD. That is the formula. So first of all, put down the formula. So the cost of capital of this firm, given that it's a geared firm, will be the weighted average cost of capital. And this is the formula for the weighted average cost of capital. Then we check from the question if we have the weights. And we have just read in note number 3 that the weight for debt is 35%. If the weight for debt is 35% proportion, then for equity will be 65%. So we have the weights. These weights we can pick from the question. Then do we have cost of equity? No, we do not have the cost of equity. What if Agostino asks, what if it was not a geared firm? How would the formula be? How would the formula be? If it was not a geared firm, it would depend, Agostino, on the information provided. And I'm just going to show you right away. Assuming that it was not a geared firm, then the cost of capital will be the cost of equity. Okay, if it was not geared, that would mean that the capital structure, in the capital structure of this company, will only have equity. And therefore, the cost of capital will be the cost of equity. Is that clear? Now, to even illustrate it, Agostino, let us assume there is no debt. Let's assume there is no debt in the capital structure. Therefore, what will be the cost of equity, given the information we have? You can see from this formula, we have the weight. The weight of equity is 0.65. The weight for debt is 0.35. Do we have cost of debt from the question? Yes, in Roman number 4, there is cost of debt of 7.4% before tax. So this cost of debt is 7.4. So we multiply this by 7.4% before tax. And what is the tax? The tax is 30%. So we deduct it. 1 minus t, 0.7. So this will give us a element of debt. Then we have to calculate now the cost of equity, which we are not provided in the question. And that is what Agostino is asking. What if it was not geared? What if it was not a geared firm? How would the formula be? Now, Agostino assumed that this one is not, it is not geared, we only have equity, this equity. What will be the formula for calculating equity? Now, to calculate equity, we need the working. To calculate this cost of equity, we need to have a working, and we are going to use the CAPM formula. Using CAPM, KE should be equal to RF plus RM minus RF times beta, equity beta. So we have to use this CAPM formula to calculate the cost of equity. Now let's check from the information provided. Do you have the risk-free rate? Yes. Note number 5, the risk-free rate is 6% plus. Do you have the return? The return on market portfolio, we have it 11% minus 6. Then there is a note number 4, equity beta is 1.6. So that is the cost of equity. How much is it? What is the rate? Hope says 14%. 14%. Is that true? Can someone confirm? Is it 14%? I need confirmation. Correct. So this is the cost of equity, 14%. With that, we can now calculate the weighted average cost of capital. How much is it? 10.913%. Correct. 10.913% is the cost of capital. Is the cost of capital, 4 marks. Cost of capital, 4 marks. 4 marks. 1, 2, 3, 4. 4 marks. Can we proceed? I told you it was one of the easiest of all the questions. Roman 3, determine the offer price for small limited using discounted free cash flow valuation method. And you can see, candidates, this question is directing you. Discounted free cash flow. That tells you that to determine the offer price, you are going to discount the cash flows. Discounted free cash flow valuation method. You understand? The offer price for small limited using the discounted free cash flow valuation method refers to the present value of small limited's projected future free cash flows. And in essence, the discounted cash flow valuation method aims to determine the intrinsic value of small limited based on its ability to generate cash flows in the future. And this method is widely used in mergers and acquisitions because it provides a comprehensive and theoretically sound approach to valuation of companies. You understand? So we're going to discount the cash flows, and the cash flows are provided in the question. Look at the second sentence. If Duet Limited acquires Small Limited, the expected results from Small Limited will be as follows. Okay? So Roman 3, the offer price. Okay, offer price. Now to calculate the offer price, we have seen we are going to discount these cash flows, and that will enable us determine the offer price. So you can see from the question we have 3 years. So one column will have the years. There are 3 years. 1, 2, 3. Then the next column will have the cash flows in thousands. We'll have the cash flows. These cash flows. Then we'll have the present value interest factor. The present value interest factor. And the rate that we computed in Roman 1, that will be the discounting rate. This is the discounting rate. Okay. Present value interest factor 10%, 10.913 N. Then we'll have the present values. We'll have the present values in thousand. So that is the formula. Okay. Are you following? To determine the offer price using the discounted cash flows valuation method, we'll have the years as given in the question. We'll have the cash flows, the future values of cash flows year 1. We will discount using the present value interest factor 10.913% N. Then we multiply by this factor by the future values. That will give us the present values. Then this total down here will be the answer. That will be our answer. So that is the formula. Okay. Cash flows. Can we proceed? Can we proceed? Can we proceed? Are we on the same page up to that point? Year 1, year 2, year 3. But you recall there was a statement on something to do with year 4 onwards. Yes, not number 1. From year 4 onwards, it is expected that the annual cash flows from small limited will increase by 4% each year in perpetuity. So from year 4 onwards, there is year to perpetuity. From year 4 onwards to perpetuity, they will also have the cash flows. So do we have the cash flows? No, we do not have the cash flows. We have the sales, the cash. So we need to calculate the net cash flows. So we are going to have a working for the net cash flows here. Workings. We are going to calculate the net cash flows. Net cash flows. The net calculation of net cash flows. We are going to have calculation of net cash flows. That is the working. Because here we have sales, year 3, year 3, year 2, year 1. Thousands, in thousands, in thousands. So what we have here, we have sales. These are sales. 300 million. 300 million. 420 million. 480 million. After sales, there is a cash expenses. cash expenses. We deduct the cash expenses from the sales. 180 million, 240 million, 270 million. Then we also have the interest charges. Interest charges 15 million, deduct 15 million, deduct 15 million, deduct. We then deduct the interest charges. Okay, interest charges. Are we following? That clear? We are calculating the net cash flows, which we need to discount here to get the present value. Then the total will be the offer price. So we take sales, deduct cash expenses, deduct interest charges. I skipped the capital allowances. That is the capital allowances, capital allowances, capital allowances, capital allowances, 30, 45, 60. 30, 45, 60. 30, 45, 60. Those are allowances which ought to be deducted. Okay, we are deducting that. Then give me the total here. Year one, 75 million. This is taxable profit. Year two, someone says 120 million. 120 million. Third year, 135,000. 135 million. Then we tax. The tax is 30%. 30% tax. 30% of 75, 30% of 120. How much is it? Year one, tax year one, tax year one. 22,500. 22,500. Year two. Lucy K, 36,000. 36 million. Deduct the tax. Year three, 4,500. 4,500. Right? 4,500. Now give me the difference. Deduct the tax from the taxable profit. That would give us the profit after tax. Year one, 52,500. 52,500. Profit after tax. 52,500. Year two, 84,000. 84,000. Third year, 94,500. 94,500. That is the profit after tax. Profit after tax. We then add back the capital allowances, add back capital allowances. Add back the capital allowances, 30, 45, 60. Add back the capital allowances. 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 Add back. Then there is also the cash flows to replace assets. Cash flows to replace assets ought to be deducted. Cash flows to replace assets. Year 1, 37,500. 45,000. 52, 52,500. 52,500. The cash flows to do what? The cash flows to replace assets and finance growth So these are outflows. So you deduct. What you get here is what we are looking for. So what will the net cash flows year 1? Net cash flows year 1. Net cash flows year 1. Net cash flow year 1. Kabasha, net cash flow year 1. Net cash flow year 1. Someone says 45 million. $45 million. Next, 84 million. The third year, what will be the net cash flows third year? 102 million. So these are the net cash flows which we are required to discount. Year 1 is 45 million. Year 2, 84 million. Year 3, 103 million. About the discounting factor? The discounting factor, year 1 is just 1 over 1 point. The discounting rate, we have it 1 point. Is it 1.1? 0913. This is the factor raised to 1. Year 2 will be 1 over 1.10913 raised to 2. Year 3, 1 over 1.10913 raised to 3. Factors. Year 3, someone sells 1 or 2. This is 1 or 2, not 1 or 3. So what are the factors? Discounting factors. Discount. The discounting factors. Year 1. Year 3 is 102. But I had written 102,000. Justice says 0.9016. 0.9016 is the discounting rate. Year 2, discounting factor 0.8129. 0.8129. That's Kevin's answer. year 3, 0.7329, 7329. Then discount. Multiply the cash flows, the future cash flows, by the discounting rate to get the present value. Year 1, how much is it? Year 1, don't round off. These are millions. Don't round off. Don't round off. 40,572. 40,572. Correct? 40,572. Year 2, 68,283. 68,283. 68,283. 68,283. 600. 68,283. Is that the position, or is it 0.6? Is it 600 or 0.6? Cannot be 600, because there are 3 zeros here. 68,283.6. Yes, Kabasha, that is true. Then the third year, Agostino says 74,755. 74,755 point something. 0.8. 0.8. 0.8. So these are 3 cash flows. Can we proceed? Yes. Now, we need to calculate the cash flows from year 4 to perpetuity. From year 4 to perpetuity. Look at the additional information number 1. From year 4 onwards, it is expected that the annual cash flows from small limited will increase by 4% each year into perpetuity, in perpetuity. Now tell me now, what will be the cash flows here? What will be the discounting factor? And what will be the present value? That is your assignment. Give me the cash flows. That is your assignment, class assignment. You do it now. Give me the figure, please. Let me hear from each and every one. What will be the cash flows, future cash flows from year 4 to perpetuity? What do you think is the cash flows from year 4 to perpetuity? That's what we read in note number 1. From year 4 onwards, it is expected that the annual cash flows from small limited will increase by 4%. From our working, we calculated the net cash flows from year 1 to year 3. Someone, please, help me with the cash flows from year 4 to perpetuity. I needed the cash flows first. This cash flow. This one. And you are right, it is straightforward. Think you are right, Justice. It is straightforward. It is straightforward because this is what we need to write there. 102. It is straightforward. Okay? It is straightforward. But I've seen you've gone ahead to give us the present value annuity factor. You've gone ahead. Multiply, Hope says, multiply the CDS by 104. Multiply the CDS by 104. Now, I needed you to try that way. multiply the CDS by 104. I think you are adding 100%. You are adding 4% to 100% to get 104%. All right. I needed you to try that way. Now, candidates, look at the question. It says, if Duet Limited acquires, the expected results from the cash flows will be as follows. We've seen the cash flows and the expenses. These are the cash flows, the sales and the expenses, and we have computed the net cash flows. At the end, after year 1, after year 2, that is the net cash flows. After year 3, we have the 102 million. This 102 million, the 102 million is what we are informed in note number 1, that is expected to grow or to increase by 4%. This 102 million, it is after the 3rd year. We are talking about 4th year, from 4th year, because these cash flows are at the end of the years. This is 45 million at the end of year 1, 84 million at the end of year 2, 102 million at the end of year 3. At the end of year 3 is the beginning of year 4. So we read here that from the 4th year, from year 4, from the 4th year onwards, it is expected that the annual cash flows from small limited will increase by 4%. So it is this 102 million from the beginning of year 4 that is going to increase at the rate of 4% into perpetuity. Now, in perpetuity means at the end of year 5, it will also grow at 4%. At the end of year 6, it will grow at 4%. At the end of year 7, it will grow at 4%. At the end of year 8, 4%. At the end of year 9, 4%. At the end of the 10th year, so we can go on and on into perpetuity, okay, continuously. So we need to calculate that amount, which we need to have it here, then we discount it. And to calculate that, we need to use this formula, P naught. The value of these cash flows will be equal to D naught. We are just using D naught, but you can use anything else, okay? It's D naught. Then we grow it at the rate of 4%. That will be into 1 plus the growth rate. Then we divide the rate cost minus the growth rate. This is the formula you covered in financial management. You recall when computing the value of cash flows that are running into perpetuity. This is the formula we use. If you are studying advanced financial management, this formula, you used it and you passed the exam. That's why you are doing this paper. There was a question that was tested in your financial management paper which you passed. And this is the formula that you use to calculate the value of cash flows that are expected to be received into perpetuity. So this D naught is the present amount of 102 million. We grow it. The growth rate is 4%. 1 plus growth rate of 4%. 4% converted into decimal is 0.04. So it will be 1.04. Then we divide it by the rate. Okay, the discounting rate, I think we had it here. That is 0.01, no, not 1, but 0.1, 0.109113 minus the growth rate. 0.04. That will be the amount we need to insert at that point. Is that clear? Yes, Agostino, you had a point. A over R minus G. That is correct. So what is the cash flows? Someone says 1534. 1534 500. 1534 500. 1534 500. 1534 500 point 217. 0.217. So the factor here, discounting factor, this is 4 years, will be 1 over 1.1093 raised to 4. That will be the discounting factor. Raise it to 4. Raise it to 4. So what is the discounting factor? 0.66. Kevin says 0.6689. 0.6689. Present value, multiply that with that, give me the present value 6608. 6608. 08. Present value. Present value. What's the present value? What's the present value? What's the present value? What's the present value? What is the present value? 10, 13. 10, 13. 10, 13, 997, 997 point something. 0.743. 0.743. Then the offer price. What is now the offer price? Get the total present values. We'll have the offer price. And that will be the answer. The offer price. The offer price. The offer price. Total will be the offer price. 1197. 1197. Someone says 1197. 1197 609 point something. 609 point 143. 143. That is the offer price. That is the offer price. These are how many marks? 8 marks. 8 marks. These are calculated values. Calculated values. Calculated values. All this just for 8 marks. Just to earn you 8 marks. 8 marks. Those are workings. You earn marks for correct entries. That is not to say that you should not show your workings. Your workings have to be shown. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. Okay, 13 entries. 13 correct entries will earn you the 8 marks. Do you see why I said this paper was, the question was easier? Easy in terms of it will take you a short time to calculate. All these values are derived directly from the question. These ones you pick directly from the question. The only tricky bit that students maybe found a challenge, those who answered this question, was at this point. That was a tricky part. This point. Another tricky trickiest part is this point. If you do not get the cost of capital correct, then all these values will be wrong. A student who didn't get the right weighted average cost of capital, then there is no way this would be correct. Okay, all these marks will be lost, including this. See, we have used it here to calculate that. You've used this to calculate this. Are you following? And you need to be very keen, and that's how the examiner tests papers. If you fail to get the right cost of capital here, then chances are, when answering this question, maybe the only answers that are not affected by this rate is this entry, and that entry. Just 3 entries. Do you understand? Any question? We are through with that question. Do we have any question? I think that last value is wrong. Which one? Which one? Which value is wrong? And you are the one who gave us the value. Which one? The last value? Justice, which value? Perpetuity? For year 4 to perpetuity. 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 He says this value is not correct. How did you arrive at this value? That is a formula. Can you please confirm? Can someone else confirm? You have to grow it. This one is growing at 4%. Any other question? Please take time, go through the questions that are related to this one in the past papers. If you come across any question that you are unable to solve, we can solve it together here on the board, but continue revising. You have enough time. Revise the past papers. Bye. Welcome to the lesson. We're going to answer April 2024 Advanced Financial Management paper. Question 2A reads, 2 assets, A and B, are known to lie on the security market line. Asset A has a beta of 0.5 and a risk premium of 4%. Asset B has an expected rate of return of 20% and a beta of 1.75. You are considering the foreign securities which are available in the market. You have security A, B, C, D, E with expected returns and betas provided. Required, determine the risk-free rate of return. Determine the risk-free rate of return. That is Roman 1. Determine the risk-free rate return. Now, candidates, in the context of this question, you can see we have asset A has a beta of 0.5 and a risk-free rate of 4%. Asset B has an expected rate of return of 20% and a beta of 1.75. Now, before we get the risk-free rate, what is beta? What is the meaning of beta? Beta. Now, beta measures the sensitivity of an asset's returns to the overall market's returns. That is to say that beta indicates how much an asset's price is expected to move in relation to the market movements. And by now I know you know that beta of 1 indicates that the price is moving in tandem with the market. That is beta that is equal to 1. Because remember, I've just said that beta measures the sensitivity of an asset's returns to the overall market. So if you have a beta of 1, that means that the asset's price is moving in tandem. It is moving at the same rate with the market. But we may have beta being greater than 1, like is the case here with the asset B. Asset B's beta is 1.75. So this 1.75 is greater than 1. What does that mean? Now, when you have an asset beta that is greater than 1, that tells you that the asset is more volatile than the market, and its price will move more than the market. The price will move more than the market. That tells you that that price is more volatile if it is greater than 1. You may also have an asset beta that is less than 1, like the one in asset A. Asset A has a beta of 0.5. 0.5 is less than 1. Now, this asset is less volatile than the market. That is to mean that for every 1% change in the market, asset A's return is expected to change by 0.5%. Is expected to change by 0.5%. And we've seen that asset B's beta is 1.75. Is 1.75, which is greater than 1. Asset B, I indicated, is more volatile than the market, meaning that for every 1% change in the market, asset B's return is expected to change by 1.75%. But we also read that these two assets lie on the same security line market. The two assets A and B are known to lie on the security market line. They both lie on the security market line. So what is a security market line? Now, a security market line is a graphical representation of the CAPM, which helps investors understand the relationship between risk and return for different assets. So asset A and B, all right, two assets A and B lie on the security market line. What does that mean? Now, since both assets lie on the security market line, their expected returns are directly proportional to their betas. That is what it entails. They are directly proportional to their betas. It is important for you to have that small knowledge, beta, because we have a column there for beta. Now let's work out the risk-free rate of return. The risk-free rate of return. I'll begin on page 1. This is April 2024, question 2A, Roman 1. We are to calculate the risk-free rate of return. The risk-free rate of return given the information. In the first sentence, we have asset B has an expected rate of return of 20% and a beta of 1.75. Then in the same question, the expected rate of return is 20%. Expected rate of return is 20% and the beta is 1.75. So, how do we determine the risk-free rate? Which formula are we going to use? We are going to use the CAPM formula. Expected rate of return is equal to risk-free rate plus the premium. The premium is RM minus RF times beta. And we are going to use the beta for asset B because that is the information we have. Asset B, we have the beta of 1.75. The expected return is 20%. We do not know the risk-free rate. How about the risk-free rate? We do not have it, but we have the beta of 1.75. 1.75 is the beta. Okay. Then what other information do we have? Asset A has a beta of 0.5 and a risk premium. So we have the risk premium. Return on the market minus risk-free, that is the risk premium. So we have the risk premium of 4%. That clear? The risk premium, we have it. And therefore, this should be equal to, this is equal to. So you see, risk-free rate is the unknown, and we are going to calculate it. This is 20% risk-free rate plus 4% times 1.75. How much is it? Kevin says 7%. Is it 7%? 7%. 4% times 1.75. Is it 7%? So you can see here, candidates' risk-free rate will be 13%. It's 20% minus 7%. 13%. Is that true? 13% is the risk-free rate. Then we are required to calculate the required rate of return. The required rate of return. There was a problem with the setting of the question here because that Roman 1 Roman 1 ought to have been part of what we have answered. Before you come to, you are considering the following securities which are available in the market. Roman 1, we are to calculate the risk-free rate. Roman 2 is independent of Roman 1. Roman 1, we were to determine the risk-free rate given the data before the table, the data before the securities shown in the table. Two securities A and B are known to lie on the security market line, are known to lie on the market security line. Asset A has a beta of 0.5 and a risk premium of 4%. Asset B has an expected rate of return of 20% and a beta of 1.7. The risk-free rate that we have computed in Roman 1, we're going to use it in determining the required rate of each security in Roman 2. Okay, so we need to make that correction in the question. The question was misplaced. Roman 1 was required to be inserted before the table. In Roman 2, we are to calculate the required rate of return. The required rate of return. Roman 2, required rate of return. Now, the required rate of return, we still use CAPM to calculate the required rate of return, which is equal to risk-free rate plus market return minus risk-free rate times the beta. And we'll calculate for each security. We have a column for the security A, B, C, D, and E. And now the E. Okay, so that's the first column. So for security A, the risk-free rate is 13%, and that will be constant for all the securities. 13%. We add the premium. Market return minus risk-free is the premium. The premium is also 4% for all the securities. Then we multiply by the beta for security A. The beta for security A is 2. That will give us the required rate of return. How much is it? For B, it will be 13 plus 4 times the beta of 0.75. C, 13% plus 4. The beta there is 1.25. D, 13% plus 4. Beta negative 0.25. E, 13% plus 4. The beta there is 3.25. So these are the required rate of returns. for each security. Kevin says 21. It's 21%. These are percentages. B, 16%. 16%. Security C, Kevin says 18%. Security D, Kevin says 12%. The last security, 26. Required rate of return, 26. So that's it. How many marks? 4 marks. 4 marks. That's 4 marks. 1, 2, 3, 4, 5. 4 marks. This was how many marks? 2 marks. 1, 2, 2 marks. Now let's answer the second part. This second or third. Identify which security is undervalued, overvalued, or correctly valued. Now, to calculate or to determine or identify which security is undervalued, overvalued, or correctly valued, we are going to compare the required rate of return and the expected return. So we're going to have another table for, this is 3. We have a table for security A, B, C, D, E. Then from the information given, we have expected return. We have a column for expected return. A, 20%, B, 14%, C, 15%, D, 12%, E, 31%. This we are going to compare with the required rate of return. Required return that we've got determined here is 21, 16, 18, 12, and 26. So to determine whether a security is overvalued, undervalued, or correctly valued, we compare the required return against the expected return. Now someone tell me, is security A overvalued, undervalued, or correctly valued? Can I hear from you? Anna says overvalued. It is above the expected. So it is overvalued, correct? Overvalued. Security A is overvalued. Now, candidates, you need to understand that expected return is the return an investor anticipates earning from a security, and required rate of return is the minimum return an investor expects to compensate for the risk of investing in the security. So when the expected return is higher, let me begin with that. When the expected return is higher than the required rate of return, it means the security is potentially offering more return than investors demand for its level of risk. And that suggests the security is undervalued. And it might be a good investment opportunity. But in the first case, the expected, in our case here, the expected return is lower. This expected return is lower than the required rate of return. That indicates that the security is not meeting investor expectations for its level of risk. It is therefore considered overvalued. And investors might be less inclined to invest in it unless the price drops. Such security A is overvalued. Now, with that knowledge, what do you think of security B? Is it overvalued or undervalued? Security B? Overvalued. Jackie says overvalued. That is correct. Security C? Overvalued. Security D? B is overvalued. D? 12. This one is correctly valued. Correctly valued. Correctly valued. Correctly valued. Then the last one is definitely undervalued. Undervalued. It is undervalued. So that would earn you just 2 marks. 2 marks. 1, 2, 3, 4, 5. 2 marks. Part C says Madarax Limited is an e-business company that trades solely over the internet. In the year 2023, the company made sales worth 15 million shillings. All sales were on 30 days credit to commercial customers. Extracts from the company's most recent statements of financial position relating to working capital are as follows: trade receivables, trade payables, bank overdraft. Additional information. 1. In order to encourage customers to pay on time, Madarax Limited proposes introducing an early settlement discount of 1% for payment within 30 days, while increasing its normal credit period to 45 days. Number 2, it is expected that on average 50% of customers will take the discount and pay within 30 days. 30% of customers will pay within 45 days, and 20% of customers will not change their current paying behavior and will pay within 60 days. 3. Madarax Limited currently orders 15,000 units per month of product P, demand for which is constant. There is only one supplier of product P. The cost of product P purchases, the cost of product P purchases over the last year was 540,000 shillings. 4. The supplier has offered a 2% discount for orders of product P of 30,000 units or more. Each order costs Madrak 150 shillings to place, and the holding cost is 0.24 shillings per unit per year. 5. Madrax Limited has an overdraft bank facility charging interest at the rate of 6% per annum. Assume 365 days in a year. Required, Roman 1. Calculate the net benefit or cost of the proposed changes in trade receivables policy and comment on your findings. 6 marks. Roman 2. Using suitable computation, determine whether the bulk purchase discount offered by the supplier is financially acceptable. Comment on the assumptions made in your computation. 6 marks. Roman 2 now is the other side of the coin. This business is selling on credit, but the business, is it buying on credit? Look at Roman 2 says, using suitable computation, determine whether the bulk purchase discount offered by the supplier is financially acceptable. Now let's analyze this one. This one is debt management of debt, management of debtors. In Roman 2, in answering Roman 2, we will rely on additional information 3. Look at note 3. Madrax Limited currently orders 15,000 units per month of product P, demand for which is constant. There is only one supplier of product P. The cost of product P purchases over the last year was 540,000 shillings. 4. The supplier has offered a 2% discount for orders of product P of 30,000 units or more. Each order costs Madrax Limited 150 shillings to place, and the holding cost is 0.24 shillings per unit. Now you can see, candidates, now this question is testing your knowledge on inventory management. Inventory management. Here we are talking about stocks. So it was 2 in 1. The candidates were tested on management of trade receivables and management of inventories. Do you realize that? It's important for you to realize that. If someone who asks me, which topic is that? It's good to think that way also. This is inventory management. Still working capital management. And working capital management is an investment. Working capital is simply the investment in inventories, trade receivables, and cash. Okay? Now, what is the formula? What is the formula? I'll give you an opportunity to answer that one. Every problem has a formula. Every problem can be solved in a certain way. What is the formula in determining whether the bulk purchase discount offered by the supplier is financially acceptable? That is what is required. So what is the formula? This is the question. This is the question. Acceptable. That's why I'm using the term acceptable. Determine whether the bulk purchase discount offered by the supplier is financially acceptable. To determine, then you need to calculate the net benefit of accepting the bulk order. So what is the formula? That's how you should be thinking all the time. This is the question. In our previous question, this was the question. So this question, what is the answer? How do you arrive at this question? How you arrived at the answer is what we call formula or approach. And every question has its own unique formula in business. There are those that may be direct, like what someone is saying here, EOQ. EOQ has a standard formula. Here we are not to calculate, what you are calculating is not a standard formula, but you need to come up with your own formula. And your own formula can only be accurate if you have understood the question. So why students have a problem is setting the wrong question. Because someone sees orders, holding costs, then one thinks what is required is the EOQ. So you say EOQ is equal to. But you see the question is not on EOQ. And the examiner required, if the examiner was to be direct, because your examiner is not always direct, because the examiner needed to just say, what is the net benefit of accepting the bulk order? That is a direct question. Because the examiner sometimes does not ask questions directly. Look at how the examiner put the question. It says, determine whether, it's a very long thing, determine whether the bulk purchase discount offered by the supplier is financially acceptable. It's not direct. So that's why you need to take time and check what is the examiner. Don't look at the details in the question. Sometimes start by reading what is required. Do you understand? Yes. Now that you've understood, give me the formula. And if the examiner had asked the question this way, what would be your answer? Please, let me get your answers. Vincent says, bulk purchase using discount, less purchase without discount. So when we began candidates, I told you when you see the word net, you are most likely comparing two things, adding things and subtracting. You cannot get net when you only have one variable the way you are saying. You see, net benefit is equal to cost of discount minus. Look at the other one. Net present value is equal to present value of debenture minus. So this is net. What is the net benefit of accepting the bulk order? What is the net? So we are comparing two things. And it's almost similar to management of debtors in note number 1. We are here dealing with policies. This was trade receivables policy. This one is inventory policy. Inventory policy. And this policy, there is an existing policy and there is a proposal to change the policy. And the proposal in relation to bulk purchase discount. So if you are to get the net benefit of accepting, please, then you are comparing the current policy and the proposed policy. You are comparing the two. Okay, to get the net benefit. It could be a benefit, could be a cost. You understand? So anytime you see net, NPV, net benefit, you are comparing 2 or 3 things. Okay? So we are to calculate or determine whether the bulk purchase discount offered by the supplier is financially acceptable. So we have the cost of the current policy This is equal to cost of the current policy minus the cost of accepting this bulk order, the proposed policy. That is the cost of inventory policy after bulk discount. Sorry. So the net benefit of accepting the bulk order will be equal to the cost of the current policy, the cost of the current inventory policy minus the cost of inventory policy after the bulk discount. We need these two things. Then we determine the net benefit. So let's now calculate the cost of the current policy. I saw some of you say order cost, something like that. Maureen says number of units bought divided by the units discounted. I know all of you are doing management accounting. Help us with your knowledge in management accounting. Cost of inventory. Candidates, cost of inventory. Let's begin with the current policy. Cost of inventory, we know, will be equal to the purchase price of the inventory. The purchase price when purchasing, you are likely to incur ordering costs plus ordering costs. Then when you go to the supplier, you will incur ordering costs, like you need to make a call, you need to send invoices, you may need to visit. All that involves ordering. There are examples of ordering costs. You make a call, you have an accountant who is preparing orders, you pay that accountant. So the cost of inventory includes the purchase price of the inventory, but related to purchasing, there are other associated costs like ordering costs. Then after you have ordered, the goods have been brought into the business, then there are also other costs which we call carrying costs, holding costs, storage costs, the same thing. Holding costs. Before you sell, these items have to be stored somewhere in a store. That store, they are, if depending on the materials or the goods that you purchase, you may need refrigeration, you may need to have a, if you are in a country where insecurity is very high, you need to have a security officer with dogs or guns, all right? You need to have surveillance, CCTV, storage, holding costs. You need to have someone preparing the store, cleaning the items, holding costs. So cost of that's the cost of inventory. So this will be the formula for that and that. I know you are management accountants. Give me the purchase price. Give me the purchase price. I've given you the formula. Abraham says 540. It's 540,000. What is the ordering cost? Ordering cost. Use your management accounting knowledge. Give me the ordering cost. Ordering cost. And it has to be the annual ordering cost. Ordering. Ordering. Abraham says 150. 150 is per order. So how many orders were made during the year? You multiply by the 150 to get the annual ordering cost. It is like buying motor vehicles in Kenya. The purchase price is lower than the taxes. Kenyans buy, the purchase price is lower than the amount you spend in ordering. You see, your ordering cost is 4.5 million per year, and the purchase price for what you've ordered is 540. It's abnormal, isn't it? But is common in developing countries. Yeah, 150 times 15. I think that makes sense. How did you get 15? That is 15. Abraham, 15,000. Let me look at the question. Madrax currently orders 15,000 units. That is not the number of orders. Those are units. And that is units per month. But we have to calculate the ordering cost per year. The 15,000, you need to be very keen. The 15,000 is units per month. We need to calculate the number of orders. Number of orders. That tells me you've not done management accounting, or you have not done that topic. I expected you to move very fast on this one. Step number 1, put down the formula. Then you see this one is not in the question. You need to work it out. Cost of the current, you need to work it out. In working out, you see the items that you can pick from the questions. Others have to be worked out. So again, we need to have a working for annual ordering cost. What is the formula for annual ordering cost? To get the formula for annual ordering cost, when you are given the cost per order, then you only require to calculate the number of orders, then multiply with the cost per order. Number of orders will be equal to the annual demand divided by the quantities ordered during every time the amount the customer orders, there is that amount that is ordered. Okay, and in this question you are given the amount. Madrax orders 15,000 units per month. Okay, so the annual demand, this we multiply by the cost per order. Let me put the formula down. The cost per order, CO, cost per order. Now to calculate the annual demand, we are told that Madrax orders 15,000 units per month. So it will be 15,000 units per month. How many months are in a year, please? How many months? How many? 12. So the numerator is the annual demand, the number of units ordered during that year. 15,000 divided by the times 12. We divide by the number of items that are ordered. If the company is operating under what we call the EOQ, if it is economic order quantity, then we'll have it. But we've not told anything to do with economic order quantity. But I see some of you are saying economic order quantity formula. Abraham, we are not, there is no economic order quantities here. Okay, we do not have economic order quantities. But we are given the number of quantities that are ordered. It may not be economical. you may need also to check what is the meaning of economic order quantity. It is not economic order quantity. We are just told Madrax orders 15,000 units per month. So you get the total number of units ordered in a year, then you divide by the 15. This will give you the number of orders. That is the number of orders. Then you multiply by the cost per order. What is the cost per order? The cost per order, 150. Each order costs 150 times 150 shillings. That is the ordering cost. Do you understand? Are you understanding? Are you understanding? It was easy, but not easy. So Abraham, how much is it? Abraham says 1.8. 1.8. It's 1.8. 1.8 million. So this is 1.8 million. We add the holding cost. And it has to be the annual holding cost. Annual holding cost. Give me the annual holding cost. What is the annual holding cost? Why dividing 15? Why dividing 15? We are dividing 1500. 15,000, not 15. It is 15. This is 15,000. It is not 15, but 15,000. We are dividing the total units that were ordered during the year. And every time an order is made, 15,000 units are ordered. So if you divide the total demand with the quantities that are ordered every time, you get the number of orders. Then you multiply with the cost per order. That is 1.8 million. You thought it was to be divided by 30. You should not think DML. You just follow the information provided. 30,000, I think it is in relation to note number 4. Note number 4 is something else. Note number 4 says the supplier has offered a 2% discount. You see, that is something different. We are calculating the annual ordering cost under the current policy. Do you get the difference? Emma, so the answer is 1.8. Yes, the answer is 1.8. The answer is 1.8. DML, now that you got it, give me the holding cost. Annual holding cost. Emma is asking, is it 1800 or 1.8? I think it's 1.8 million. Emma is 1.8 million. 1.8 million. Because it's 15,000 times 12. Is it 1.8 thousand? It's 1.8, not 1.8 million. I think, Emma, you are right. That is 1,800. It's 1,800, correct? This is 1,800. You divide this, you get 1,800. Because this is, I think, 12 times 150. There are 12 orders. One order is 150 shillings. That is correct, Emma. Then give me the annual holding cost. Annual holding cost. If you have covered that topic, how do you calculate the annual holding cost? You are just going to use the same concept, the same razor blade. Please use this razor blade. It is almost the same razor blade. In Swahili we say wembe ni ule ule. Wembe ni ule ule. Omiti, half Q. Give me the answer. Half Q. Yeah, you are right. Half Q. CI, where C is a C. What is CI? I prefer CH. Carrying cost. It's not CI but CH. Carrying cost or holding cost. Or HC. Yeah, HC or CC. Not CI but CC. Holding cost. Which language have they used? Holding cost. So use the same. You have an idea. Now give me the amount. You see how things are related. It's like we are doing management accounting. 31,250. How did you arrive at 31,250? What did you divide by what? Because we have the holding cost per one. Look at note number 4. Is it number 4? Yes. Each order costs 150 shillings to replace, and the holding cost is 0.24. 0.24 shillings. That is the storage cost, or the holding cost, or the carrying cost. So to calculate the annual holding cost, you will multiply the units with the 0.24. What is the answer? Annual holding cost. Someone says 1.8. Omit 1.8. 1.8. So the formula, for the sake of those who've not done management accounting, we are going to have it Q. We are going to take Q over 2 times holding cost per unit, which is equal to the 1500. 1.5 we divide by 2 times 0.24, which is equal to 18. So this is 18. So what is the total cost of inventory? What is the total cost of inventory? Total cost of inventory. Total cost of inventory. What is the total cost of inventory? We have the purchase price plus the ordering cost plus the annual holding cost. What is the total? $543,600. 543,600. 543,600. 543,600. Is that true? 543,600 minus cost of inventory under the new policy. Please confirm. That's the answer. So let us calculate the purchase price, ordering cost, holding cost under the new policy. Under the new policy. Is that true? Is it 543? Yes. Can I rub the board? Can I rub? You've done that, so we don't need this. We'll use the same formula. Formula is the same. Annual ordering cost under current policy and old policy is the same. Now give me the ordering cost under the current policy, where there is bulk discount. What is the ordering cost? What is the ordering cost? We know the annual demand does not change. The annual demand is constant. So this annual demand we know is constant. It's 1500. Is it 1500? Yes, times 1200. 15,000 times 12. That will give us the annual demand. We divide by the quantity. Under the new policy, what is the quantity? Under the new policy, what is the quantity? So what is the order quantity under the new policy? It is written there in note number 4. The supplier has offered a 2% discount for orders of product of 30,000 units or above. How much is it? 30,000. So what is the answer? Ordering cost. 30,000 is the quantity ordered. Get the number of orders, then multiply by 150. Number of orders, then multiply by 150. It is true, this is 30,000. Under the new policy, this company will not be ordering 15,000 units, to be ordering 30,000 units because there is a bulk order. You understand? It has gone up. It's 30,000. So this will give us the number of orders. Then cost per order is 150. Okay? So the formula here is still the same. Annual ordering cost, someone? Annual ordering cost. Is it your internet that is slow? Irene says 900. Yes, 900. Ordering cost 900. This is 900. How about the annual holding cost? You get the number of units multiplied by the cost. Holding cost is 0.24. So give me, yeah, you are right, 6 orders, DML, that is 6 orders, times 0.24. Is it orders? No, it's not orders, it's just 6. Q over 2 is not orders, DML. Yeah, it's 6 orders for annual ordering cost, correct? But you are now working on holding cost. You are right, 6 orders. Which is equal to 900. Now give me the annual holding cost. Annual holding cost. Kevin says 3600. Yeah, 3000 divided by 2 times 0.4, 3600. 3600. How about the purchase? The purchase price. So this is how this is calculated. 3000 divided by 2 times 0.24. That should give you 3600. We've done the annual ordering cost. We've done the holding cost. Give me the purchase price. 30,000. Give me the purchase price. So this should be 30. For those of you who are taking notes, let us be accurate. This is 30,000. 30,000. We need to calculate the purchase price. under the new policy. You are not supposed to think. The information is given and it's direct. We read that in note number 4, the supplier has offered a 2% discount. Okay. So what is the, yes, 98%. So what will be the purchase price? DML, you are right. There are many ways of calculating it. So 98%. What will be the purchase price? It will no longer be 540 because there is a discount of 2%. The purchase price before the discount is 540. So the purchase price before discount, the purchase price before the discount is 540,000. And there is a discount of 2%. So 540,000 is represented by 100%. So less 98%. We just multiply this by 98%. That will give you the purchase price. It is less 2%. So if it's less 2%, then it's 98%. 98% of 540, DML says 520, 529, 200. 529, 200. This is 529, 200. So what is the total cost? What is the total there? Which is the total here? This is equal to 529. 529, 200. Give me the total cost of inventory under the new policy. Total. Kevin says 533, 700. 533, 700. 533, 700. 533, 700. So what's the difference? The difference is the net benefit. The difference is the net benefit. 9,900. It's 9,900. Is it negative or positive? Is it negative or positive? The cost of inventory, that is the purchase price, ordering cost, and holding cost is 543,600 before the policy. After the policy, after the change in policy, the cost has gone down by 9,900. Therefore, this is a net benefit. If the company was to accept the bulk order discount, then there is a benefit of 9,900. So candidates were to using suitable determine whether the bulk order by the supplier is financially acceptable. So the answer is the bulk purchase discount offered by the supplier is financially acceptable because of the net benefit of accepting the bulk order. Then candidates were to comment on the assumptions made in the computation. Assumptions made in the computation. What are the assumptions? Give me 2 assumptions. We are just to give 2 assumptions. Each assumption is a half a mark. And you see, even if you didn't have anything to say, you could comment on the assumptions because the assumptions are constant. When you are calculating cost of inventory, the assumptions that are made. So what is your assumption? Correct. Annual holding cost is constant. That's what DML says. That is correct. What is the other assumption? So it is the holding cost and the ordering cost. So you can see from the question, the holding cost is 0.24 under the old and the new. The ordering cost again is also constant, 150 under the old and the new. So one assumption is that the ordering costs and holding costs are assumed to be constant, which we know is unlikely to be true in reality. Another assumption made here is the annual demand. The annual demand is assumed to be constant, whereas in practice we know that there could be seasonal and other changes in demand which may occur. So those are the two assumptions, or even three. Annual cost is assumed to be constant, ordering cost is assumed to be constant, annual demand is assumed to be constant. Questions? Ask questions. We've answered these questions. This is 6 marks. The other question here is also 6 marks. 6 marks. 1, 2, 3. They are marks for workings. 6 marks. Do you have questions? Is there anything you've not understood? If you can understand this one, then you can understand any other. For the other questions I've seen, they are very direct. Questions that have been tested before, quite direct. And I see most of you have been answering questions. I'm very impressed because I know with just a bit of effort in practicing the past paper questions, you should be able to be scoring all these marks. It's possible. Right? Any question? Anyone? Any question? The name advanced does not mean complicated. Advance means continuation. To advance is to continue. It's not complicated. So that's why topics in advance. The topic we are covering, like the capital budgeting, we have advanced capital budgeting. You advance. Okay. When you say so and so is advanced in age, it doesn't mean the person is complicated. No, it means that the person has lived for long. So advanced means you are covering what you are not covered in intermediate level, because it's not possible to cover everything. So that's why you learn bits, then you go to the next stage, you learn more. All right. So this level may look trickier because you are studying, for example, working capital management for the first time. You are studying advanced capital management for the first time. When you get to the advanced level, what you are studying here is the same. We've seen the examiner testing questions from the intermediate level. Like the other setting, there was a question in advanced level on capital rationing, what you've just covered. And there are times when there are questions from advanced level which may also be tested in financial management because the concepts are the same. So by mastering all these concepts, you are making your life easier when you get to advanced level. Okay? So financial management is just financial management. In practice, there is no advanced financial management. It's just financial management. Do you understand? When you get into practice, we do not have advanced financial managers. No, they are just finance managers. And maybe Kasneb should consider changing the word advanced to something else, right? In fact, during our time, subject like financial accounting, we used to call it financial accounting 1, financial accounting 2, financial accounting 3. But you see today they are calling it financial accounting, financial reporting, advanced. but it's just accounting. We do not have advanced financial accounting managers. No. Management accounting is just management accounting. When you apply for a job, you are called management accountant, finance manager, accountant. You understand? So what you are learning now is what you will just meet in future. Time value of money, valuation of financial instruments, the formula is the same. So anyone who told you that advanced financial management is difficult is one who didn't attend the lessons that you are attending. All right? You have 30 days. 30 days times, these are days. How many hours are there in a day? Hours, 24. So you have more than 72, is it? Days. Yeah. So you have many hours ahead. Okay. So I think it's just in August when you have the exams and you are doing well. I hope to meet you in our next session. If there is no any other question, we've done questions on working capital management. We've done questions on capital management. We've done questions on evaluation of instruments. I think we've covered almost each of the areas. I'll be looking at, when we meet next time, a topic that we've not covered. So what you do, please go back to the past papers, attempt questions, revise questions on, for example, working capital management. This question, there was a question on management of debtors and management of inventory. There are questions again on management of cash. So you see, the examiner nowadays is very clever. He's trying to set questions from all the topics. Like this one has been split. There's a question on working capital, yes, but he's covered all. It's possible to have a question on all those aspects. So go back to the question papers, take advantage of revision books, which I think we have revised up to, is it, I think April 2024. So thank you. Bye bye. Welcome to the lesson. We're going to answer April 2024 Advanced Financial Management paper. Question 2A reads, two assets, A and B, are known to lie on the security market line. Asset A has a beta of 0.5 and a risk premium of 4%. Asset B has an expected rate of return of 20% and a beta of 1.75. You are considering the foreign securities which are available in the market. You have security A, B, C, D, E with expected returns and betas provided. Required, determine the risk-free rate of return. Determine the risk-free rate of return. That is Roman 1. Determine the risk-free rate return. Now, candidates, in the context of this question, you can see we have asset A has a beta of 0.5 and a risk-free rate of 4%. Asset B has an expected rate of return of 20% and a beta of 1.75. Now, before we get the risk-free rate, what is Beta. What is the meaning of beta? Beta. Now, beta measures the sensitivity of an asset's returns to the overall market's returns. That is to say that beta indicates how much an asset's price is expected to move in relation to the market movements. And by now I know you know that beta of 1 indicates that the price is moving in tandem with the market. That is beta that is equal to 1. Because remember, I've just said that beta measures the sensitivity of an asset's returns to the overall market. So if you have a beta of 1, that means that the asset's price is moving in tandem. It is moving at the same rate with the market. But you may have beta being greater than 1, like is the case here with the asset B. Asset B's beta is 1.75. So this 1.75 is greater than 1. What does that mean? Now, when you have an asset beta that is greater than 1, that tells you that the asset is more volatile than the market, and its price will move more than the market. The price will move more than the market. That tells you that that price is more volatile if it is greater than 1. You may also have an asset beta that is less than 1, like the one in asset A. Asset A has a beta of 0.5. 0.5 is less than 1. Now, this asset is less volatile than the market. That is to mean that for every 1% change in the market, asset A's return is expected to change by 0.5%. Is expected to change by 0.5%. And we've seen that asset B's beta is 1.75. Is 1.75, which is greater than 1. Asset B, I indicated, is more volatile than the market, meaning that for every 1% change in the market, asset B's return is expected to change by 1.75%. But we also read that these two assets lie on the same security line market. The two assets A and B are known to lie on the security market line. They both lie on the security market line. So what is a security market line? Now, a security market line is a graphical representation of the CAPM, which helps investors understand the relationship between risk and return for different assets. So asset A and B, all right, two assets A and B lie on the security market line. What does that mean? Now, since both assets lie on the security market line, their expected returns are directly proportional to their betas. That is what it entails. They are directly proportional to their betas. It is important for you to have that small knowledge, beta, because we have a column there for beta. Now let's now work out the risk-free rate of return. The risk-free rate of return. I'll begin on page 1. This is April 2024, question 2A, Roman 1. We are to calculate the risk-free rate of return. The risk-free rate of return given the information. In the first sentence, we have asset B has an expected rate of return of 20% and a beta of 1.75. Then in the same question, the expected rate of return is 20%. Expected rate of return is 20% and the beta is 1.75. So, how do we determine the risk-free rate? Which formula are we going to use? We are going to use the CAPM formula. Expected rate of return is equal to risk-free rate plus the premium. The premium is RM minus RF times beta. And we are going to use the beta for asset B because that is the information we have. Asset B, we have the beta of 1.75. The expected return is 20%. We do not know the risk-free rate. How about the risk-free rate? We do not have it, but we have the beta of 1.75. 1.75 is the beta. Okay. Then what other information do we have? Asset A has a beta of 0.5 and a risk premium. So we have the risk premium. Return on the market minus risk-free, that is the risk premium. So we have the risk premium of 4%. That's clear? The risk premium, we have it. And therefore, this should be equal to, this is equal to. So you see, risk-free rate is the unknown, and we are going to calculate it. This is 20% risk-free rate plus 4% times 1.75. How much is it? Kevin says 7%. Is it 7%? 7%. 4% times 1.75. Is it 7%? Muhammad Hassan says 0.07. Convert it into percentage. That will be 7%. So you can see here, candidates' risk-free rate will be 13%. It's 20% minus 7%. 13%. Is that true? 13% is the risk-free rate. Kabasha, welcome. Then we are required to calculate the required rate of return. The required rate of return. There was a problem with the setting of the question here because that Roman 1 ought to have been part of what we have answered, before you come to, you are considering the following securities which are available in the market. Roman 1, we are to calculate the risk-free rate. Roman 2 is independent of Roman 1. Roman 1, we were to determine the risk-free rate given the data before the table, the data before the securities shown in the table. Two securities A and B are known to lie on the security market line, are known to lie on the market security line. Asset A has a beta of 0.5 and a risk premium of 4%. Asset B has an expected rate of return of 20% and a beta of 1.7. The risk-free rate that we have computed in Roman 1, we're going to use it in determining the required rate of each security in Roman 2. Okay, so we need to make that correction in the question. The question was misplaced. Roman 1 was required to be inserted before the table. In Roman 2, we are to calculate the required rate of return. The required rate of return. Roman 2, required rate of return. Now, the required rate of return, we still use CAPM to calculate the required rate of return, which is equal to risk-free rate plus market return minus risk-free rate times the beta. And we'll calculate for each security. We have a column for the security A, B, C, D, and E. And are the E. Okay, so that's the first column. Then, are we together? Hannah, we are answering April 2024. So for security A, the risk-free rate is 13%, and that will be constant for all the securities. 13%. We add the premium. Market return minus risk-free is the premium. The premium is also 4% for all the securities. Then we multiply by the beta for security A. The beta for security A is 2. That will give us the required rate of return. How much is it? For B, it will be 13 plus 4 times the beta of 0.75. C, 13% plus 4. The beta there is 1.25. D, 13% plus 4. Beta negative 0.25. E, 13% plus 4. The beta there is 3.25. So these are the required rate of returns for each security. So can I have the answers? Kevin says 21. It's 21%. These are percentages. B, 16%. 16%. Security C, is it 18? Kevin says 18%. Security D, Kevin says 12%. The last security, 26. Required rate of return, 26. So that's it. How many marks? How many marks? 4 marks. 4 marks. That's 4 marks. 1, 2, 3, 4, 5. 4 marks. This was how many marks? 2 marks. 1, 2, 2 marks. Now let's answer the second part. This second or third. Identify which security is undervalued, overvalued, or correctly valued. Now to calculate or to determine or identify which security is undervalued, overvalued, or correctly valued, we are going to compare the required rate of return and the expected return. So we're going to have another table for, this is 3. We have a table for security A, B, C, D, E. Then from the information given, we have expected return. You have a column for expected return. A, 20%, B, 14%, C, 15%, D, 12%, E, 31%. This you are going to compare with the required rate of return. Required return that we've got determined here is 21, 16, 18, 12, and 26. So to determine whether a security is overvalued, undervalued, or correctly valued, we compare the required return against the expected return. Now someone tell me, is security A overvalued, undervalued, or correctly valued? Roger says undervalued, undervalued, undervalued. Roger says undervalued. Any other attempt? Anna says overvalued. It is above the expected. So it is overvalued, correct? Overvalued. Security A is overvalued. Now, candidates, you need to understand that expected return is the return an investor anticipates earning from a security. and required rate of return is the minimum return an investor expects to compensate for the risk of investing in the security. So when the expected return is higher, let me begin with that. When the expected return is higher than the required rate of return, it means the security is potentially offering more return than investors demand for its level of risk. And that suggests the security is undervalued. And it might be a good investment opportunity. But in this case, in the first case, the expected, in our case here, the expected return is lower. This expected return is lower than the required rate of return. That indicates that the security is not meeting investor expectations for its level of risk. It is therefore considered overvalued. And investors might be less inclined to invest in it unless the price drops. So security A is overvalued. Now, with that knowledge, what do you think of security B? Is it overvalued or undervalued, security B? If security A is overvalued, what of security B? I've seen many candidates confusing. That's why I'm taking time to explain, so that you don't just memorize, but you should have the understanding. Why is it overvalued? I've explained why it is overvalued and the implication of overvaluing it. B is overvalued. That is what Jackie says. Overvalued. Jackie says overvalued. That is correct. Security C. Overvalued. Security D. B is overvalued. D. 12. This one is correctly valued. Correctly valued. Correctly valued. Then the last one is definitely undervalued. Undervalued. It is undervalued. So that would earn you just 2 marks. 2 marks. 1, 2, 3, 4, 5. 2 marks. Welcome to the lesson. We are going to answer question 2. That is April 2024. Question 2. A, B, and C. A, B is just 4 marks. Differentiate between a unit trust and a mutual fund. Candidates were to give just 2 points to distinguish unit trust from mutual fund. And candidates, these two, the unit trust and the mutual fund, are both collective investment schemes that pool money from multiple investors to invest in diversified portfolio of assets. You understand? Both are collective investment schemes. Both collect money from different investors, and that money that is collected from different investors is invested in a diversified portfolio of assets. Now, when distinguishing such schemes, distinction can be on the basis of the legal structure. The legal structure, how are they formed? You can get a distinction by looking at their legal structure. And the first one here is which one? The unit trusts are or is structured as a trust. All right? The unit trust, the name even suggests that it is structured as a trust with a trustee holding the assets on behalf of the investors. Remember, I said that both unit trusts and mutual funds are collective investment schemes that pool money from different investors, and then they invest in assets. So unit trust is structured in a way of a trust, and trust we know have trustees. So a unit trust must have a trustee who holds the asset on behalf of the investors. That is the structure of a trust. For the mutual fund, now mutual funds are typically structured as corporations or investment companies. A mutual fund is a company and is formed based on it's just like a normal company, right? The Companies Act is governed by the provisions of the Companies Act. So a mutual fund is a corporation or an investment company with a board of directors. All right? Remember, we are distinguishing based on the structure. This one has a board of directors, but a unit trust has a trustee who holds the assets on behalf of the investors. But for the mutual fund, it is a company that has a board of directors that oversees the operations of the fund. So that's the first distinction based on the structure. Another way to distinguish the two is trading. Trading, all right? Now, as for the unit trust, the units are bought and sold directly with the fund manager at a price that is determined by the net asset value of the underlying assets. All right. Now, units are just like shares. When you invest in a unit trust, you buy units. And we are saying here, the units are bought and sold directly with the fund manager. You understand? We are talking about trading. How do you buy the units? If you are to invest in a unit fund, the units are bought directly from the fund manager and they are sold through the fund manager at a price that is determined by the net asset value of the underlying assets of the unit fund. How about trading of mutual fund? Now, remember I said that mutual fund is a corporation. It is a company. And if it is a company, then we are dealing here with shares. If it's a mutual fund, then the shares are bought and sold on a stock exchange at a price that is determined by the market demand and supply. Okay. Now, there are many more distinctions, but we not go much into the distinctions. But I'm just helping you. When you are distinguishing such, you can distinguish them on the basis of the structure, legal structure, on the basis of trading, and you can even distinguish on the basis of benefits. Okay, so that is the distinction. You are to give true to earn the 4 marks. Let's move on to part B of the question. Sophia Wambia intends to invest 2 million shillings in a 12% debenture for 3 years. The current market value of the debenture is 80 shillings per debenture. The required rate of return on the debenture is 10%, and the par value is 100 shillings. Required, advise the investor on or not to invest in the debenture. 4 marks. Okay. Sophia Wambia intends to invest 2 million in a 12% debenture for 3 years. The current market value of the debenture is 80 shillings per debenture. The required rate of return on the debenture is 10%, and the par value is 100 shillings. Advise the investor on whether or not to invest in the debenture. So that is a question. 4 marks. 4 marks. So how do we go about this one? How do we go about? Now, what will be the basis of this advice? Because we need to do some calculations before we advise. Now, to advise Sophia, we'll be required to have 2 variables. That is a value of the debenture. We'll have to calculate the value of this debenture. Then we compare the value of this debenture with the market value of the debenture. So we just need 2 things. The value of the debenture. How do you calculate the value of the debenture? We calculate the value of the debenture, then we compare that value of the debenture with the market value, the current market value of the debenture, which is given 80 shillings per debenture. The amount shown there, 2 million, is irrelevant. Someone is asking, this question falls under which topic? This is valuation. There's a topic on valuation of securities. That should be topic number. It's on valuation. The topic part B is valuation. Part C is different topic, but part B is on valuation. So I've given the direction. We need to calculate the present value of the future debenture cash flows. Then we deduct the market value of the debenture. Then we can advise based on the answer we get. This is B. We are going to compare 2 things. Okay? And that will give us, it's like an NPV. You're going to have the present value of debenture cash flows minus the current market value of the debenture. The current market value of the debenture, we have it, is 80 shillings. But we do not have the present value of the cash flows expected to be derived from the debenture. To determine the the value of a debenture, we get the present value of the expected cash flows from that debenture. And from the question, this debenture has two cash flows. One is the interest. All right. The current market value of the debenture is 80. Then there is that interest. Sophia Wambio intends to invest 2 million in a 12% debenture. That 12% is the interest that Sophia is expected to receive from this investment for the period of 3 years. 12% debenture for 3 years. That interest is the expected cash flow from the debenture. Then at the end of the 3 years, Sophia will get back the par value, that 100 shillings. The required rate of return on debenture is 10%, and the par value of the debenture is 100 shillings. Okay, that is the par value. That is the par value. So we are going to get the present value of these two cash flows. We deduct from the current market value, then we'll advise. So that is the formula. Anything else is just workings. So step number 1, put down the formula. Then check from the question if you have the inputs. Already we have the current market value, but we need to calculate the present value of the debenture cash flows from the debenture. And I've said that there are two cash flows, interest and the par value. So the present value of a debenture, the formula, the present value of the debenture will be the interest times present value interest factor. The rate here is 10%, 3 years, plus this is an annuity, supposed to be annuity, present value interest factor of annuity. It is an annuity, 10%, 3 years. We add the par value times present value interest factor. This is an interest, is a lump sum, 10%, 3 years. So Sophia will be receiving interest at the rate of the rate is 12%. So therefore, candidates, what is the interest? The interest is 12% of the par value. That is the interest. This interest is 12% times 100. This is the interest times this factor. What is the factor from your tables? Annuity factor, 10%, 3 years. Annuity factor, 2.4869. 2.4869. So that is interest. This is how to calculate interest. You take the interest is given 12%, okay, times the par value 100 shillings. So we multiply the factor 2.4869 That will give us a present value of the interest. Then we add the par value. We discount the par value. These 100 shillings will be received at the end of the third year. So we discount it. So that's going to be 100 times present value interest factor, 10% 3 years. What is the factor? 0.7513. 0.7513. Okay. So how much is it? 12% times 100 is just 12 shillings times 2.4869 plus 100 shillings times 0.7513. How much is it? 104, 97.96, 104.97, 104.9728. That is the present value of this debenture, 104.9728. What's the difference? Is it positive or negative? It is positive. That is positive. Frigin, what is the present, the net, the NPV? How much? Positive 24.97, 24.9728. Advice. You see, this is positive NPV. That is the positive NPV. Advise the investor on whether or not to invest. The advice is invest. Invest. Why? Because it yields a positive NPV. The NPV is positive. So someone had asked the 2 million. That 2 million is irrelevant. The 2 million is irrelevant. Maureen is asking, how are you getting 24? Is the difference. The difference between 104 minus, there is 80 here, the current market value. That's how we are getting 24. That clear, Maureen? Yeah, there is 80. Maybe you came in after we had written it. To advise this client, you have to calculate the present value of debenture cash flows. Then you compare with the current market value. The current market value. If it's positive, the investor can invest. If it's negative, then you should shun away from such investment. All right. Can we proceed? DML is asking, in what scenario could have the 2 million been relevant? In what scenario could the 2 million have been relevant? Now you see that 2 million is like it is a root. It's just a root to the question. The 2 million is a way of making the question look practical. You have to imagine that the investor would invest 2 million shillings. The question can be varied in many ways, including number of debentures. You can use the 2 million to calculate the number of debentures. Like this investor has 2 million shillings and wants to invest in a debenture whose market value is 100 shillings per debenture. So how many debentures is Sophia likely to buy? So the question can be varied from that angle. If you want to know or calculate the number of debentures, the 2 million can help you determine the number of debentures. And that's why DML, you need to look at, we'll be looking at different questions, how the valuation of debentures, the questions can be varied. I think there are a number of questions in past papers. We'll be seeing how the question can be varied. So we'll look at different scenarios as we move along. We will have an opportunity to work out similar questions, but tested in various ways. But the 2 million, most candidates were confused with the 2 million. Some candidates worked with the 2 million shillings. And the moment you begin to work with the 2 million, then you see you get it wrong. You may not be able to advise because using 2 million will not get you anywhere. Because the question was very specific. Advise the investor on whether or not to invest in the debenture. That's why I always say it's important to take a break and understand the question, then find out what may be the formula to answering the question. And there is no specific formula. The formula may vary depending on the question. There is no, the formula sometimes is not standard. Okay, it's not like the formula for calculating area of a circle. No, here the question, the formula can vary. Whichever way a question is tested, as long as it's computational, there has to be a formula, and the formula is just an approach on how to answer it. When I say formula, I'm not referring to the formula in the book. No, every problem is unique, and if every problem is unique, then it calls for a unique approach or formula or a way to solve it. Look at part C. Part C says Madarax Limited is an e-business company that trades solely over the internet. In the year 2023, the company made sales worth 15 million shillings. All sales were on 30 days credit to commercial customers. Extracts from the company's most recent statements of financial position relating to working capital are as follows: trade receivables, trade payables, bank overdraft. Additional information. 1. In order to encourage customers to pay on time, Madarax Limited proposes introducing an early settlement discount of 1% for payment within 30 days, while increasing its normal credit period to 45 days. Number 2, it is expected that on average 50% of customers will take the discount and pay within 30 days. 30% of customers will pay within 45 days, and 20% of customers will not change their current paying behavior and will pay within 60 days. 3. Madarax Limited currently orders 15,000 units per month of product P, demand for which is constant. There is only one supplier of product P. The cost of product P purchases over the last year was 540,000 shillings. 4. The supplier has offered a 2% discount for orders of product P of 30,000 units or more. Each order costs Madarax 150 shillings to place, and The holding cost is 0.24 shillings per unit per year. 5. Madrax Limited has an overdraft bank facility charging interest at the rate of 6% per annum. Assume 365 days in a year required. Roman 1. Calculate the net benefit or cost of the proposed changes in trade receivables policy and comment on your findings. 6 marks. Roman 2. Using suitable computation, determine whether the bulk purchase discount offered by the supplier is financially acceptable. Comment on the assumptions made in your computation. 6 marks. All right. This is where there was a bulk of marks. The one we did is just 4 marks. The theory one is 4 marks. Here we need to score 6 marks. 6 marks. C, Roman 1. Net benefit or cost. Net benefit or cost is equal to. If you get this one right, then the problem is half solved. Abraham says net benefit is equal to current policy minus proposed policy. Omiti says net benefit is equal to current policy minus proposed policy. And that's how the examiner caught students off guard. Almost all questions on working capital on trade receivables, the examiner gave, if you look at the past papers, the examiner always gives details on the current policy and the information on the proposed policy. Then candidates are required to calculate the difference, to get the difference. What is the benefit of the cost, the cost of the current policy and cost of the proposed policy. Then you check if the net is positive or negative. But you see, this one was a bit unique. The question was unique because there is no specific information on where you could have current policy and proposed policy. And if you are keen, you would realize that Roman 1 required candidates to calculate the net benefit or cost of the proposed changes. It is net benefit or cost of the proposed changes in trade receivables. But previously, if you look at the other questions, it's not specific to trade receivables. Trade receivables, if you read the other questions, past paper questions, trade receivables is just one element in calculating the cost of proposed and current policies. We always have trade receivables where we calculate the opportunity cost of holding, of having trade receivables or debtors. What you are writing here is what we have done in previous past paper questions, but this one is unique. It is net benefit or cost of the proposed changes in trade receivables. It's specific to trade receivables. But what you are writing here is when you are looking at the whole policy. Here is a benefit related or cost related to trade receivables. But when you say current policy minus proposed policy, you have in your mind the whole policy. But this one is related to trade receivables. Do you understand? Have you understood what I've said? Have you understood that point? You need to read the question clearly. The question is, net benefit or cost of the proposed changes in trade receivables. If the net benefit or cost was to be determined in relation to trade receivables only, then you need to narrow down to information related to trade receivables in the question. You understand? Because the question is specific to trade receivables, and therefore you need to, when analyze the question, you need to identify what information are you given that relates to trade receivables. And you can see in note number 1, it reads, in order to encourage customers to pay on time. That is the information we are going to use, because that information relates to trade receivables. And trade receivables, by now you should know, are just debtors, customers, those who that owe the business, those who buy from the business on credit, is what we are referring to as trade receivables. So additional information number 1 will be useful. Then additional information number 2 reads, it is expected that on average 50% of customers. So number 2 will help us in calculating Roman 1. But look at note number 3. Look at additional information 3 says, Madarax Limited currently orders 15,000 units per month of product P. Orders. So that is irrelevant to Roman 1, because here, if it is ordering, we read further, there is only one supplier. So that information will not help us in calculating Roman 1. The same will happen to additional information number 4. The supplier has offered a 2% discount for orders of product P. So that information will not help us in calculating the net benefit or cost in Roman 1. Okay? So, what is the formula? Calculate the net benefit or cost of the proposed changes in trade receivables policy. It is a trade receivables policy. So what are the changes? There is a way that this company has operating. But the company is now considering making changes in the trade policy. This company has been selling on credit to its customers, and we've given the number, the amount of trade receivables is 2,466,000, and all sales were on 30 days credit to commercial. 30 days, that was it. Those were the terms. Pay within 30 days, that is the debtors collection period. The company is considering changing that, what now we are calling trade receivables policy. And we have read in note number 1 of the kind of changes the company wants to introduce. So I'm asking, what benefits do you think this company will enjoy as a result of the change in the trade receivables policy? Because we need to calculate the net benefit or cost. And Vincent has said that customers will pay early as per required. That is correct. The reason why the discounts are being allowed, the company is introducing a discount, 1% discount. The purpose, even the question answers what I'm asking. It says, in order to encourage customers to pay on time, proposes introducing an early settlement discount of, all right? Let me hear from Omiti says because of the discount, they take advantage, thus they pay early. Similar to the other answer, they pay early. Now, when customers pay early, that is a good thing, is it not? Yes, it is a good thing, because when customers hold the company's money for a long time, there is the opportunity cost associated with customers holding your money. It's like you've advanced them money. If someone is holding your money for 30 days, for 45 days, that money would have used it to do something else, which you are not doing. So that's what we are referring to as the opportunity cost. So by giving this 1% discount, the objective is to entice, to motivate, to cause the customers to pay early so that they take advantage of the discount. Do you understand? You need to understand, because these questions nowadays, they are not like the ones some of us did. The questions are a bit tricky. They are not uniform. But if you get understanding, you will have an easy time answering these questions, right? The idea behind changing the policy, the idea behind introducing this discount is to make the customers pay so that the business will have the money. But again, you see that discount to the business is a cost. That is discount allowed. Discount allowed is an expense. So that is one thing that is going to help us calculate the net benefit or cost. So one thing is discount. There is cost of discount. Cost of discount. All right. The cost of discount, that is a cost. There is a discount, which is a cost. That is one. You're still working out the formula, because if you don't get this one, then even the calculations are meaningless. Okay? But I want you to get the understanding. The first element is the cost of discount. We must analyze the discount because it is a cost. Okay? Then what will be the benefit? What will be the benefit? This is a cost to the company, but what will the company benefit? This discount benefits the customers, okay, encouraging them to pay early, because they only enjoy the discount after paying early, and the business has to give a discount. Discount means the business is selling at a lower price by 1%. So it's a cost, but we are analyzing net benefit or cost. So what will be the benefit? That is the $6 million question. What will be the benefit? The benefit. What is the benefit? And if you have been listening to me, I just said it. I just mentioned it. Out of my many words, I mentioned it. All right? Any want to try that one? Frigin says, money received now is better than money received in future. Time value of money. The company can invest the money in other projects or the same. That is, you are talking business language, which is okay. There is truth in what Frigini says. As the money are received, Vincent says, as the money are received early, they will be reinvested again to more benefit. That is still okay. That is true. That is true. But I hope you've understood up to this point. That policy, the policy, someone has an answer? The company will keep on selling more products and staying on the market. That is also true. It will keep on selling more products because the debtors have paid, and that money that the debtors have paid can be used to buy more goods and also to buy and sell. The cycle continues. That is correct. Now, you've understood the discount. The discount is a cost. All right. Now look at note number 5. Madras has an overdraft bank facility charging interest at the rate of 6%. Put that at the back of your mind. Now, this company, candidates, has been selling its products, and the debtors collection period is 30 days. The company wants to change the policy so that customers can pay early. They've introduced a discount for payment within 30 days. All right. So the discount is meant to encourage the customers to pay early. So there'll be a benefit in the sense that there'll be a reduction. There'll be a reduction in the cost of holding these debtors. There'll be a reduction in the cost of holding the debtors. Because I had mentioned earlier, when debtors keep your money, there is a cost, what we are calling an opportunity cost. So by allowing a discount, then the debtors will reduce. You will not have a large figure for debtors. It's going to reduce because they are paying. And we have seen that the current debtors, look at the extract. The current debtors or trade receivables is 2,466,000. That is the current level of debtors. The discount is meant to reduce this amount of trade receivables because they are going to pay. You understand? So that reduction is a benefit to the organization. Reduction in financing, in that financing cost. You understand? Have you understood? Because we are now want to move to calculate the cost and the reduction in financing of the debtors. Have you understood? Yes, I mentioned opportunity cost. I mentioned opportunity cost. All right, I can proceed. So, minus reduction in financing costs. So we need to get these two. Then we'll have and the 6 marks. Okay. Anything else, just workings. Reduction in financing costs. The level of debtors will reduce, meaning the company will not have take overdraft to finance debtors. There is an overdraft in the books. You can see there is an overdraft of 3 million. All right, there is an overdraft of 3 million. So that and that overdraft in note number 5, I told you to put at the back of your mind the overdraft. Look at note number 5. Madrax has an overdraft bank facility charging interest at the rate of 6% per annum. So if the debtors will reduce, then that value is again going to reduce. Okay? Have you understood? Can I proceed? All right. So let's begin with the reduction in financing costs. Reduction in financing costs. Now, reduction in financing cost will be equal to the rate is 6% times the reduction. You're talking about reduction. As a result of the discount, the amount of debtors will reduce. Then that reduction will apply the 6% to get the reduction in financing cost. So we need to get the reduction. By reduction, we are meaning the difference between the current policy, current debtors, trade receivables, let me use debtors, minus proposed. The debtors in the proposed policy, proposed. The difference will apply the 6%, which is the cost. Then we'll get the reduction in financing costs. So that will be the formula for calculating reduction in financing costs. So we have 6%. Do we have current debtors? Yes, we have current debtors. Look at the extract from the company's financial statements. The first item there is trade receivable. That's the current. 24 66000. The proposed, we have to calculate that input, and that is what Abraham talked about. Abraham made a comment. Abraham made a comment and said the debtors will be split into two. The debtors will be split, but whether they will be split into two, time will tell. Okay? Whether they'll be split into two, time will tell. Time will tell. So, how do we calculate the debtors under the proposed policy? Now, look at note number 2. It says, it is expected that on average 50% of customers will take the discount. So that is the first category of debtors. Okay? Will take the discount and pay within 30 days. And pay within 30 days. Okay? Then 30% of customers will pay within 45 days. That is a second category of debtors. Okay, 45. Then there is and 20% of customers will not change their current paying behavior and will pay within 60 days. So you see we have trade receivables within receivables. We have receivables within, is it 30 days? Within 50 days. We have trade receivables within 50 days. Then we have within, it is expected that 50% of customers will pay within 30. This is 30 days. Within 30 days. Then 30% of customers will pay 45. Then there is another category within 45 days. Another category within 60 days. So the debtors Abraham will be split, but not into two, but into three. Those who will pay within 30 days, those who will pay within 45 days, and those who will pay within 60 days. Then we get the total. That will give us the debtors under the proposed policy. Is that clear? Can I proceed? Can I proceed? Can I proceed, Mike? Can I proceed? Yes, Vincent says yes. Yeah, we can proceed. So what is the amount of the debtors that will pay within 30 days? Now, the debtors that will pay within 30 days, we read that 50% of customers, 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 and the customers, the value of the credit sales we know is it 15 million or 150 million? 15 million. It's 15 million. 50% of customers is 50% of 15 million. %50 of 15 million are likely to pay within 30 days. And given that we have the credit sales and we have the, how do you call it, the debtors payment period, and the number of years, we have the, number of days. So we multiply this with the debtors payment period of 30 days over 365 days. That is the receivables within 30 days. "45 days, the percentage, is it 30%? 30% of customers will pay within 45 days. 30% of the 15 million will pay within 45 days. So we have 45 over 365. Now here we are using knowledge of ratios. How do you calculate the receivables when given the number of days and the debtors collection period and the credit sales? You need those three to calculate the receivables. In 60 days, it's the balance, because this is 50%, 30%, the balance is 20% of 15 million, 60 over 365 days. Then give me this total. You see, calculating is easy once you have understood it. Now that you understood, you see we are moving very fast. Eh? Are we clear on that, Moses? What is the receivables? Trade receivables paying within 30 days. Trade receivables paying within 45 days. Trade receivables paying within 60 days. What is the total revised? The total revised receivables. This is the total revised receivables. Kevin says the first is 6164. 616438. 616438 point what? 64.38, because that is the full amount. Allow me to just round it off to 38. Yes, 616438. Round it off to the nearest shilling. 616438. The second is 554,795. 554,795. 554,795. Receivables paying within 60 days. 493,151. 493, 551, 151. 151. Give me the total revised trade receivables. Total. The total is 1,664,1664. 1664, 384. 384. This is the revised trade receivables. Proposed debtors. That will be that is the figure we are calculating. This is a working for these proposed debtors, which is equal to, this is 1664, 384. Then we apply on the difference, we apply the 6% to get reduction in financing cost. How much is it? 6% of the difference. 6% of the difference. Someone 48, round it off to the nearest cent. 48,097. 48,097. 48,097. That is the reduction in financing cost. 48,097. 48,097. So about the discount. The discount, not number 2, not number 1. In order to encourage customers to pay on time, Madrax proposes introducing an early settlement discount of 1% for payment within 30 days. So the discount is 1%. This is working 1, working 2, discount. The discount is 1% of what? 1%. Look at note number 2. It is expected that on average 50% of the customers will take the discount and pay within 30 days. All right. So only 50% will take advantage of the discount. So it will be 1% of 50% times 15 million. That is the discount. Is it difficult to obtain that? English. The question is written in English. It is the discount we are told is 1%. Then you are told it is expected that 50% of the customers will take the discount. The customers are 15 million. So 50% of means times. So 50% times 15 million. 50% times 15 million times the discount rate. That will give us a discount. What is the discount? Vincent says 75. 75. 75,000. 75,000. 75,000. So 75,000. So the net benefit or cost will be the difference. So you see what to do the difference? What is the difference? 26,903. 26,903. 26,903. 6 marks. 6 marks. 1, 2, 3. The workings just 3 marks. 3 marks. 3 marks. 6 marks. It was easy. Easier than the one we did yesterday. This is easier than the one we did yesterday. Gaspard, correct. That is the right answer. That is the answer. Moses, we are answering question April 2024, if that is your question. And that is just part 1, Roman 1. Abraham, what did we calculate with to get 40,087? 40,087. What did we calculate with? What did we calculate with to get 40? What did we calculate with to get 48,097? DML, that is, you are thinking rightly. You are thinking correctly. The question didn't require us to advise, but your thinking is perfect. What did we calculate with? What did we calculate with 1664 to get 1664? Now it's asking, what did we calculate with this? What did we calculate with? What did we calculate with this to get this? First of all, you need to understand we are calculating reduction in financing cost. Reduction in financing cost. That's why I took time to explain this reduction in financing cost. This needed a working, and this is the working for reduction in financing cost. The company Abraham is changing its policy so that customers pay. And one way to make customers pay, the company is introducing a discount of 1%, okay, for those who will pay within 30 days. So the purpose for that policy or introducing the discount is to enable the debtors to pay early. So for us to get that reduction in financing cost, because you need to understand when debtors hold your money, there is a cost implication. These debtors are financed by the overdraft. The company takes a bank overdraft to finance debtors. And the company pays 6%. We read that an overdraft bank facility charging 6%. So this 6%, if the debtors are many, then the company will have to incur a 6% overdraft bank facility. But if the debtors reduce, then the company will pay less cost of, the cost will be less. The rate is the same, but the amount will reduce. So as a result of the discount, the debtors have reduced from 2,466,000 to 1,664,384. This difference, this reduction, it is a reduction in debtors. So it is a benefit to the company. It has gone down. Okay? That is to say, under the current policy, before the proposal, the cost of trade receivables is 6%. Under the current, let me help you out here. Under the current policy, the cost is 6% times the current amount of debtors of 24,66,000, okay, which we got an amount. Under the proposed policy, the cost of funding trade payables under the proposed policy will still be 6%, but you see the amount has gone down from this to that. This is 64, 384. So when you, this figure is higher than the other figure. So what you get here is 48. This is 48,097. That is the reduction in financing cost. This is financing of the trade receivables. It has gone down by 48,097. Do you understand? I got it. Moses is asking, I'm asking, why did we use 6% in calculating of reduction in financing? We use 6% because that is the cost that we are given in the question note number 5. Madrax Limited has an overdraft bank facility charging interest at the rate of 6% per annum. So the bank takes an overdraft. I mean, the company borrows money from the bank and the bank charges 6%. That is why we are using 6%. Overdraft is money borrowed from the bank to fund trade receivables. Because I said, when you have debtors in your books, there is a cost associated with the debtors. The debtors are holding your money. As they are holding your money, your operations have to continue. So what the business is doing here is debtors are holding money for 30 days, 60 days. Before they pay, the business takes an overdraft to fund its expenses, all right? Because here we are talking about working capital management. This is a question from the topic on working capital management. If people are holding your money, then you have to look for other sources so that you can pay rent, you can pay salaries, you can even buy more stock. You can imagine if you are running a shop and you have you have stock worth, say, 10 million, and you sell all the stock, 10 million, to debtors, you see, you've converted your money to stocks, then you have given customers the stock. So they are holding your money, 10 million. So if people are holding your money for 30, 45 days, 60 days, how will you be running your business before they repay, before they pay the debtors, before they pay? You are supposed to pay rent, you're supposed to pay expenses, you are also to pay more stock so that you can continue trading. So the money, that's why I took time to explain. You need to understand the money that the debtors are holding. Okay, if you have debtors, then the debtors are holding your money, and there is an opportunity cost, because if that money would have been used to fund the current assets and to pay for the day-to-day obligations. So what does Madrax do? The Madrax goes to the bank so that he can continue trading as these debtors are planning to pay within 30 or 60 days. That's why there is a change in policy, so that these individuals, these customers, do not hold the money for a long time. To encourage them to pay, you tell them, I'm going to give you 1% discount so that you can receive your money and save on taking overdrafts, because overdrafts come at a cost. Moses, that's why we are using 6%. And that's why some businesses don't encourage selling on credit, because selling on credit can be expensive. Like supermarkets, you don't go to the supermarket and tell them you want to will be paying after 30 days. If you do that, the supermarket may not have money to trade tomorrow. And those are some of the policies we learn in working capital management. Aggressive policy, lenient policy. So an aggressive policy is where a business insists on receiving money promptly, but on the other hand, the business buys on credit. Part B of the question, which reads, Cosmos Operators Limited have an optimal capital structure given as follows. There is that capital structure: ordinary share capital, reserves 16%, debt 10%, preference share capital. Additional information: number one, the firm is considering raising 20 million shillings for an expansion program, of which 2 million is expected to be raised from internal sources. Number two, new ordinary shares will be issued at 35 shillings each. A flotation cost of 5 shillings per share issued will be incurred. 3. The firm's most recent earnings per share is 3 shillings. The firm adopts 50% payout ratio as its dividend policy. Dividends are expected to grow at the rate of 5% each year in perpetuity. 4. New 10% irredeemable debentures will be issued at 110 shillings each. A flotation cost of 10 shillings per debenture will be incurred. 5. New 10% irredeemable preference shares will be issued at 40 shillings each. Corporation tax rate is 30%. Required Roman 1. Retained earnings breakpoint, 2 marks. Roman 2. The number of new ordinary shares to be issued to raise the desired external equity, 2 marks. Roman 3. The weighted marginal cost of capital in each of the intervals between the breakpoints. So that is B. Retained earnings breakpoint. Retained earnings breakpoint. That is the question. But first of all, what is the meaning of retained earnings breakpoint? Retained earnings breakpoint. Now, retained earnings breakpoint is the maximum amount of money a company can raise using its retained earnings without needing to issue new stock. You understand? Or without interfering with the capital structure. So this retained earnings breakpoint is important for various reasons. One reason is that companies aim for an optimal mix of debt and equity financing. So when a company exceeds its retained earnings breakpoint, it has to raise more equity, which can disrupt the mix or the balance between equity and debt. So that is why it's important to determine the breakpoint when investing in new projects. But that's why we are to calculate the weighted marginal cost of capital. Weighted marginal cost of capital is the weighted additional cost of capital, the additional cost of capital on projects. So one reason why the retained earnings breakpoint is important is so that the company can maintain its capital structure. Another reason is that issuing new stock often comes with additional costs like underwriting fees, like flotation costs, which can dilute the value of existing shares. And that can drive up the company's weighted average cost of capital, making it more expensive to raise money in the future. You see, in this case, the firm is considering raising 20 million for an expansion program, of which 2 million is expected to be raised from internal sources. Do you understand? I'm trying to explain the meaning of retained earnings breakpoint, and I've said it is the maximum amount of money a company can raise using its retained earnings, because retained earnings is a limited source of capital. It's not unlimited. And even if it is unlimited, a company has to maintain the mix, a balance. A company may have 50-50 capital structure, 50% debt, 50% equity. So even if a company may have enough retained earnings to finance its projects, there is that maximum amount of money that can be raised from retained earnings. And that's what is referred to as the breakpoint. Another reason, giving you reasons why this breakpoint is important. Another reason is that staying below the retained earnings breakpoint, staying below, because you are saying it is the maximum. So the reason for staying below gives companies more financial stability. Why? Because they can now fund new projects or investments without relying on external sources of capital. And that helps the company to avoid dilution and higher costs. All right? So that is the meaning of retained earnings breakpoint. How is it calculated? What is the formula for retained earnings breakpoint? Now, to calculate the retained earnings breakpoint, you are going to take we read that the firm is considering raising 20 million for an expansion program, of which 2 million is expected to be raised. So this is equal to the expected amount to be raised. Expected amount to be raised, we divide by equity proportion. Equity proportion or equity ratio. Okay, that is the formula. So we have the 2 million, then we divide by the equity proportion, which we do not have. So we need to determine the equity proportion by looking at the structure, by looking at the capital structure. Do you understand? Are we moving together or moving along? Is there any question up to that point? Is there any question? The retained earnings break point is calculated by dividing the expected amount to be raised, which is 2 million. We divide by the equity proportion. So we'll have a working. To calculate the equity proportion, we need a working. Going to start, and this working is working on the a working of the proportions, because we need to have the proportion. So we need to have a column for the source. So the first source here is equity. From the capital structure, equity is a source, then there is debt, is a source of capital. We have 10% preference shares. Preference shares. That's clear? We are determining the proportions, the capital structure proportions. Capital optimal. This is working for optimal capital structure proportions. So we just check from the capital structure. B, we read, look at B. Cosmos Operators Limited have an optimal capital structure, and that structure is given. We have ordinary shares, we have reserves, we have 16% debt, then there is 10% preference shares, 10% preference shares. All right. So what is the amount for equity? Now equity is in two parts: ordinary share capital and reserves. Reserves are part of equity. So that is 80 million plus 20 million, which is equal to 100 million. It's 100 million. That is ordinary share capital and reserves. Debt, 16% debt, 40 million. Preference shares, 60 million. What will be the total? The total here is it not 200,000? Then we'll have the proportions. Proportions. So 100 million divided by 200 million, that is 0. Is it not 0.5? It's just a half. 100 is a half of that. Then 40 divided by 200. What is the proportion? Someone? Jackie. Give me the proportion for debt. Proportion for debt. give me the proportion for debt. Jackie says 0.2. How about the other one? The proportion for preference is how much? Proportion for preference 0.2, correct? So it will be 0.2 plus 0.3. That will give us the total 0.2, 0.3. So 1.0. So these are the proportions. We are calculating the proportion so that we can apply the proportion here, 0.5, to get the retained earnings breakpoint. Retained earnings breakpoint. How much is it? $4 million. 4 million is the breakpoint. 4 million is the breakpoint. 4 million is the breakpoint. Breakpoint 2 marks. These are 2 marks. 1, 2. 2 marks. Moving on well. Yes. Then Roman 2, the number of ordinary shares to be issued, to be raised. The number of ordinary shares to be issued to raise the desired external equity. Look at the question again. The number of new ordinary shares to be issued to raise the desired external equity. And we read in additional information, look at note number 2. New ordinary shares will be issued at 35 shillings each. A flotation cost of 5 shillings per share issued will be incurred. So you have to calculate the number of new ordinary shares to be issued to raise the desired external equity. Desired external equity. Let me do away with this. This is just a working. Do away with this working. Do away with this working so that we can calculate Roman 2. Roman 2, number of new ordinary shares. Number of new ordinary shares will be equal to the desired equity to be raised. We divide it by the issue price minus flotation cost. What is the desired equity to be raised? What is the desired amount to be raised from equity? That information should be given. New ordinary shares will be issued at 35 shillings, each flotation cost of 5. Someone give it a try. What will be the desired equity? What will be the desired equity? Desired equity, someone. Jackie says to me 10 million. Where did you get 10 million? Stays 10 million. Is it indicated somewhere 10 million? The desired amount is 10 million minus 2 million. So ask me why. I can't just answer, maybe you understood. Is it the 2 million? No, it is not the 2 million. It is 10 million divide by, not divide, but minus 2 million. Equity. Why? Rogers, correct. 2 million is from internal source. 2 million is the retained earnings, which is part of equity. So if the total equity is 10 million, then what the company is desiring to issue, the ordinary shares are to be issued from outside, will be less than 2 million, because out of this 10 million, 2 million will come from internal sources. So what is to be desired is desired to be raised. The question is the number of ordinary shares to be issued. These shares will be issued to new shareholders. So we have to deduct 2 million, then we divide by the issue price. We are told that the issue price is 35 shillings. Then you have to deduct, because you are issuing, there will be flotation costs. There will be flotation costs of 5 shillings per share. 5 shillings per share. So that will be the number of shares, of new shares, number of new ordinary shares that the company desires to raise. How much is it? Do you understand? Kevin says 266,667. You round it off, shares cannot be in decimals. 266,667 shares, new shares, will be raised to fund this project. 2 marks. 2 marks. 1, 2. 2 marks. 2 marks. Is that okay? Yeah, Hannah got the same figure. So let's proceed and calculate the weighted marginal. The weighted marginal cost of capital in each of the intervals. In each of the intervals. The weighted marginal cost of capital in each of the intervals between the breakpoints. The weighted marginal cost of capital in each of the intervals between the breakpoints. So let's do it. Now these will take some, you're going to have tables. You do it in a table. We are going to do it in a table. The weighted marginal cost of capital in each of the intervals between the breakpoints. And we've seen that the first break will be at 4 million. All right. So let's put down the table. This is Roman. You have to calculate the weighted marginal cost of capital. First column will be the range of total financing. Then you'll have sources of capital. Another column is a proportion proportion. Proportion, specific cost of capital in percentage. Then lastly, you're going to have the weighted cost. The weighted cost. Right? Range of total financing, sources of capital, the proportion, the cost, and the weight. To get the weight, we multiply the proportion by the specific cost. You understand? You need to get the table correct first. Range of total financing. So the first range is 0 to 4 million. That is the first range. 0 to 4 million. That's where we have the first break. 0 to 4 million. And here we have which sources. First of all, we are going to exhaust retained earnings. Okay? The retained earnings. Now look at the information given. The firm is considering raising 20 million for an expansion program, of which 2 million is expected to be raised from internal sources. New ordinary shares will be issued. Okay. Then we are told there that new 10% in note number 4, new 10% redeemable shares will be issued at 110 shillings each. We have the flotation cost. In note number 5, we read new 10% redeemable preference shares will be issued at 40 shillings each. So this is the information we are going to use in calculating the weighted marginal cost of capital. So we begin with the first break, the first range, 0 to 4 million. 0 to 4 million is the first break. And the source here is equity. Then we have debt. These are sources which are going to fund this project. Debt, redeemable debentures, that is debt. Then we have preference shares. Preference shares. Okay. Equity, debt, preference shares. Equity, debt, preference shares, and the proportions we calculated here. If you are writing, we have the proportions. The equity was 0.5, 50%, 20%, 30%. So we are required to calculate the specific cost for these sources. The specific cost for these sources. So I'm going to have a working. I'm going to have here workings. 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 So equity, and candidates, this is where you need to be attentive. Equity, by now you know, comprises of ordinary share capital, reserves, retained earnings, unappropriated profits, premium. All that is part of equity. In funding this project, we saw that the firm will first of all raise money internally from retained earnings. So during the first break, the first range, we need to calculate the cost of retained earnings. What is the cost of retained earnings? We are determining the specific cost. What is the formula for calculating cost of retained earnings? This is equal to D naught, all right, into 1 plus G raised to P naught plus G. This will give us the cost of retained earnings. What is a D naught? D naught is the current DPS, the current DPS. In note number 3, we read that the firm's most recent earnings per share is 3 shillings. That is earnings per share. Next sentence reads, the firm adopts 50% payout ratio. So what is the dividend? So out of the 3 shillings, shareholders are paid 50%. Payout ratio, 50%. So 50% of 3 shillings is 1.5 shillings. That is the current. You need to just begin with the tense and the language. The most recent. This is the current DPS is 1.5. Then plus 1 plus growth rate. What is the growth rate? The growth rate, we have it. Do we have it? We have it. Yes, the growth rate is 5 shillings, 5%. Dividends are expected to grow at rate of 5% each year in perpetuity. So it will be 1.05. We divide by the market. This is the market price of this share, the MPS. Do we have the MPS? MPS. Do you have the MPS? Do you have the MPS? MPS. New ordinary shares will be issued at 35. Yes, 35. 35. Is it 35? Plus 0.05. That will give us the cost of retained earnings. How much is it? 9.5. Roger says 9.5. 9.5. So the cost of retained earnings is 9.5. 9.5%. Then cost of debt. Cost of debt, KD. How do you calculate cost of debt? Cost of debt is equal to the interest over VD 1 minus T. That is the formula for cost of debt. So what is the interest? To determine the interest, look at the note number 4. New 10% irredeemable debentures will be issued at 110 shillings each. A flotation cost of 10 shillings per debenture will be incurred. There is a flotation cost on this debenture. So what is the interest? Give me the interest. We divide by the market price of the debenture. It's very simple. To get the interest, you calculate the rate which is given at 10%. You apply it on the par value. The par value. The debenture will be issued. The par value of this debenture is 100 shillings. Just 10% of 100. Is it not so? 10% over 100 shillings, that is the interest. Interest is just 10% over 100. 10% over 100. You are told new 10%. So you take 10% and multiply by the par value that is shown in the capital structure. So 10% over 100 is equal to 10. We divide by the market value of this debenture. Note number 4, new 10% debentures will be issued at 110 shillings. That is the market price, but there is a flotation cost. So the amount there, the amount is 110, but we need to deduct the flotation cost because it is being issued. So it will be less the flotation cost times 1 minus tax. This is 0.7. Roger says 7%, 7%, 7%. So the cost of debt, 7%. Then we move to calculate the cost of preference shares. Cost of preference shares, KP. KP. What is the formula for KP? We need to calculate the preference shares. The cost of preference shares is equal to DP. DP is the debenture. I mean the dividend. DP over PO times 100. So we check from the question, what is the dividend? All right, preference dividend. Preference dividend, look at the capital structure. Preference, 10% preference share capital, 10% preference share capital, 10%, look at the capital structure, 10% preference dividend. And the par value per dividend is 30 shillings. So the dividend is 10, is it 10? Yes, 10% times 30 shillings. That is the dividend. That is the dividend per share. This is DP, dividend per share, 10% times 30. That is the par value. So in calculating the dividend, you have to apply the par value, the dividend rate times the par value. That's it. Then what is the market value of this dividend? Do we have it? Market value of the dividend. Do we have it? The market value. The par value is 30. We are not told that the dividend increased. The par value, we are not informed whether it increased. That is not number 5. The question is silent. No, it says new 10% irredeemable preference shares will be issued at 40. Will be issued at 40. That is the market. That is the market value of that preference share. So this will multiply by 100. Will give us the cost of preference. How much is it? 7.75? Yes, 7.75, correct. 7.5. That is the cost of each source. Cost of each source. Now to calculate the weighted cost, you multiply the proportion by the specific cost. So what is 0.5 times 9.5%? What is 0.2 times 7%? What is 0.3 times 7.5%? Kevin says 4.75. 4.75%. Debt, what is the cost? 1.4. 1.4%. Preference, weighted cost preference, 2.25. 2.25. Please confirm. 2.25. 2.25%. Then give me the total cost. Total cost. 4.75 plus 1.4 plus 2.25%. What is the total? Samuel says 8.4%. So this is 8.4%, and that is the WMCC at that point. WMCC. Is that clear? That is the first break range, 0 to 4 million. Then the next range will be above 4 million. Above 4 million. Above 4 million. We need to calculate again the weighted average cost of capital at this range, beginning with equity, debt, preference. The proportions must remain 0.5, 0.2, 0.3. We know the cost of debt and cost of preference shares will not change. This will be constant, 7%, 7.5%. So the only cost that will change is equity, because above 4 million, above 4 million, we are no longer going to use retained earnings, but we will use, the company is going to issue new shares, because 4 million is the retained earnings breakpoint. Beyond 4 million, the company cannot rely on retained earnings. You will recall we defined retained earnings breakpoint as the maximum amount of money a company can raise using retained earnings without needing to alter the capital structure. So during the first range, this is the cost. Above 4,000, the company will not use retained earnings, but it's going to use ordinary share capital. Issuing ordinary share capital, the cost of issuing ordinary share capital is not the same as the cost of issuing retained, of raising money using retained earnings. That's why the cost of equity above 4 million range is going to change. That's why we need to have a working for cost of equity. Cost of equity. This was cost of retained earnings. I want you to get the difference and get the understanding. If you've not understood this concept, please get the understanding today. There are many students who find it difficult, but it doesn't need to be difficult. put your mind in what we are doing today. Don't postpone to understand. It's very easy for you to come to this class and postpone, and you have divided attention. Just pay attention to what we are saying, and you'll get the understanding of when we say range of total financing, range between 0 to 4 million, the range about 4 million. Get an understanding that retained earnings breakpoint is the maximum amount of money that a company can raise using its retained earnings without altering its capital structure. Okay? Or without needing to raise money through issue of shares. So I'm repeating, the first range, 0 to 4 million, the company is to raise retained earnings, and the cost of equity is 9.5%. And now that the company is issuing ordinary shares, the cost of these ordinary shares will not be the same as the cost of retained earnings, because the formula is D naught into 1 plus G over P naught plus G. And there is flotation cost here. I think it is clearly indicated that flotation cost will be 5 shillings per share. So this will be equal to the D naught will be at 1.5 shillings into 1.05 over 35 minus 5 plus 0.05. So give me the cost of equity there. I know you have understood here. So what is the cost of equity? 10.25. 10.25%. 10.25%. You see, candidates, the cost of equity has gone up from 9.5 to 10.25. Why? Because cost of equity is always higher than cost of retained earnings. So give me the weighted cost, 0.5 times 10.25, 0.2 times 7%, 0.3 times 7.5%. 5.125, 5.125. Debt, weighted cost debt, Jackie, 1.4, 1.4%. Preference, 2.25, 2.25%. Total, the total is 8.775. 8.775. 8.775 is the weighted average cost, the weighted average marginal cost. So, but the question is the weighted marginal cost of capital in each of the intervals between the breakpoints in each. So the first break point, that is it. The second break point, that is it. So the range of total financing 0.0 to 4 million, the cost is 8.4%. Above 4 million, the cost is 8.775. This cost is lower because the company used retained earnings. The cost of retained earnings is always lower compared to cost of equity, which is higher, and you've seen that is why we have the difference, because you see cost of debt did not change, cost of preference shares did not change. That is 1.4, 1.4, 2.25, 2.25. So the cost has gone up because after the first break, the company had to issue ordinary share capital, and issuing ordinary share capital is expensive because of the flotation costs. And you recall we say that issuing new stocks often comes with additional costs like flotation costs, underwriting costs, and that can dilute the value of existing shares. It may also drive up the company's weighted average cost of capital. Do you have a question? We've done question 2, April 2024. Last week, we answered question 1. Is there any question? If there is no question, I would urge you to go to the past papers, identify similar questions. These questions are very common, and the examiner likes asking these questions because most students don't answer this question in the exam. It was tested last time, it may be tested again. And you can see it's very straightforward if you understand the concept. You need to understand what is retained earnings breakpoint. It is a question that has been tested many times. Even in the lower level, financial management is a common question. So ensure to practice, attempt past paper questions. If you have any that you are not able to answer, I can help you answer the question here. But first of all, make sure you attempt questions related to breakpoints, retained earnings breakpoints. We are doing past paper questions. I'm assuming you've gone through the whole syllabus, so we're doing the most recent. We're doing April 2024, then we are going to do December 2023, August 2023, April 2023. Bye. Welcome to the lesson. We're going to answer April 2024 Advanced Financial Management paper. Question 2A reads, two assets, A and B, are known to lie on the security market line. Asset A has a beta of 0.5 and a risk premium of 4%. Asset B has an expected rate of return of 20% and a beta of 1.75. You are considering the foreign securities which are available in the market. You have security A, B, C, D, E with expected returns and betas provided. Required, determine the risk-free rate of return. Determine the risk-free rate of return. That is Roman 1. Determine the risk-free rate return. Now, candidates, in the context of this question, you can see we have asset A has a beta of 0.5 and a risk-free rate of 4%. Asset B has an expected rate of return of 20% and a beta of 1.75. Now, before we get the risk-free rate, what is beta? What is the meaning of beta? Beta. Now, beta measures the sensitivity of an asset's returns to the overall market's returns. That is to say that beta indicates how much an asset's price is expected to move in relation to the market movements. And by now I know you know that beta of 1 indicates that the price is moving in tandem with the market. That is beta that is equal to 1. Because remember, I've just said that beta measures the sensitivity of an asset's returns to the overall market. So if you have a beta of 1, that means that the asset's price is moving in tandem. It is moving at the same rate with the market. But you may have beta being greater than 1, like is the case here with the asset B. Asset B's beta is 1.75. So this 1.75 is greater than 1. What does that mean? Now, when you have an asset beta that is greater than 1, that tells you that the asset is more volatile than the market, and its price will move more than the market. The price will move more than the market. That tells you that that price is more volatile if it is greater than 1. You may also have an asset beta that is less than 1, like the one in asset A. Asset A has a beta of 0.5. 0.5 is less than 1. Now, this asset is less volatile than the market. That is to mean that for every 1% change in the market, asset A's return is expected to change by 0.5%. Is expected to change by 0.5%. And we've seen that asset B's beta is 1.75. Is 1.75, which is greater than 1. Asset B, I indicated, is more volatile than the market, meaning that for every 1% change in the market, asset B's return is expected to change by 1.75%. But we also read that these two assets lie on the same security line market. The two assets A and B are known to lie on the security market line. They both lie on the security market line. So what is a security market line? Now, a security market line is a graphical representation of the CAPM, which helps investors understand the relationship between risk and return for different assets. So asset A and B, all right, two assets A and B lie on the security market line. What does that mean? Now, since both assets lie on the security market line, their expected returns are directly proportional to their betas. That is what it entails. They are directly proportional to their betas. It is important for you to have that small knowledge, beta, because we have a column there for beta. Now let's work out the risk-free rate of return. The risk-free rate of return. I'll begin on page 1. This is April 2024, question 2A, Roman 1. We are to calculate the risk-free rate of return. The risk-free rate of return given the information. In the first sentence, we have asset B has an expected rate of return of 20% and a beta of 1.75. Then in the same question, the expected rate of return is 20%. Expected rate of return is 20% and the beta is 1.75. So, how do we determine the risk-free rate? Which formula are we going to use? We are going to use the CAPM formula. Expected rate of return is equal to risk-free rate plus the premium. The premium is RM minus RF times beta. And we are going to use the beta for asset B because that is the information we have. Asset B, we have the beta of 1.75. The expected return is 20%. We do not know the risk-free rate. How about the risk-free rate? We do not have it, but we have the beta of 1.75. 1.75 is the beta. Okay. Then what other information do we have? Asset A has a beta of 0.5 and a risk premium. So we have the risk premium. Return on the market minus risk-free, that is the risk premium. So we have the risk premium of 4%. That clear? The risk premium, we have it. And therefore, this should be equal to, this is equal to. So you see, risk-free rate is the unknown, and we are going to calculate it. This is 20% risk-free rate plus 4% times 1.75. How much is it? Kevin says 7%. Is it 7%? 7%. 4% times 1.75. Is it 7%? So you can see here, candidates' risk-free rate will be 13%. It's 20% minus 7%. 13%. Is that true? 13% is the risk-free rate. Then we are required to calculate the required rate of return. The required rate of return. There was a problem with the setting of the question here because that Roman 1 ought to have been part of what we have answered. Before you come to, you are considering the following securities which are available in the market. Roman 1, we are to calculate the risk-free rate. Roman 2 is independent of Roman 1. Roman 1, we were to determine the risk-free rate given the data before the table, the data before the securities shown in the table. Two securities A and B are known to lie on the security market line, are known to lie on the market security line. Asset A has a beta of 0.5 and a risk premium of 4%. Asset B has an expected rate of return of 20% and a beta of 1.7. The risk-free rate that we have computed in Roman 1, we're going to use it in determining the required rate of each security in Roman 2. Okay, so we need to make that correction in the question. The question was misplaced. Roman 1 was required to be inserted before the table. In Roman 2, we are to calculate the required rate of return. The required rate of return. Roman 2, required rate of return. Now, the required rate of return, we still use CAPM to calculate the required rate of return, which is equal to risk-free rate plus market return minus risk-free rate times the beta. And we'll calculate for each security. We have a column for the security A, B, C, D, and E. How many are they? E. Okay, so that's the first column. So for security A, the risk-free rate is 13%, and that will be constant for all the securities. 13%. We add the premium. Market return minus risk-free is the premium. The premium is also 4% for all the securities. Then we multiply by the beta for security A. The beta for security A is 2. That will give us the required rate of return. How much is it? For B, it will be 13 plus 4 times the beta of 0.75. C, 13% plus 4. The beta there is 1.25. D, 13% plus 4. Beta negative 0.25. E, 13% plus 4. The beta there is 3.25. So these are the required rate of returns for each security. Kevin says 21. It's 21%. These are percentages. B, 16%. 16%. Security C, Kevin says 18%. Security D, Kevin says 12%. The last security, 26. Required rate of return, 26. So that's it. How many marks? 4 marks. 4 marks. That's 4 marks. 1, 2, 3, 4, 5. 4 marks. This was how many marks? 2 marks. 1, 2, 2 marks. Now let's answer the second part. This second or third. Identify which security is undervalued, overvalued, or correctly valued. Now, to calculate or to determine or identify which security is undervalued, overvalued, or correctly valued, we are going to compare the required rate of return and the expected return. So we're going to have another table for, this is 3. We have a table for security A, B, C, D, E. Then from the information given, we have expected return. You have a column for expected return. A, 20%, B, 14%, C, 15%, D, 12%, E, 31%. This we are going to compare with the required rate of return. Required return that we've got determined here is 21, 16, 18, 12, and 26. So to determine whether a security is overvalued, undervalued, or correctly valued, we compare the required return against the expected return. Now someone tell me, is security A overvalued, undervalued, or correctly valued? Can I hear from you? Anna says overvalued. It is above the expected. So it is overvalued, correct? Overvalued. Security A is overvalued. Now, candidates, you need to understand that expected return is the return an investor anticipates earning from a security. And required rate of return is the minimum return an investor expects to compensate for the risk of investing in the security. So when the expected return is higher, let me begin with that. When the expected return is higher than the required rate of return, it means the security is potentially offering more return than investors demand for its level of risk. And that suggests the security is undervalued. And it might be a good investment opportunity. But in this case, in the first case, the expected, in our case here, the expected return is lower. This expected return is lower than the required rate of return. That indicates that the security is not meeting investor expectations for its level of risk. It is therefore considered overvalued. And investors might be less inclined to invest in it unless the price drops. So security A is overvalued. Now, with that knowledge, what do you think of security B? Is it overvalued or undervalued? Security B? Overvalued. Jackie says overvalued. That is correct. Security C? Overvalued. Security D? B is overvalued. D? 12. This one is correctly valued. Correctly valued. Correctly valued. Correctly valued. Then the last one is definitely undervalued. Undervalued. It is undervalued. So that would earn you just 2 marks. 2 marks. 1, 2, 3, 4, 5. 2 marks. Hello and welcome back to the lesson. Today we are going to answer question number 3, Advanced Auditing and Assurance, December 2023. We've done question 1 and 2. Today we are going to do question 3. In our next session, we'll do question 4 and 5. Question 3 reads as follows. CompuMax Limited is one of your audit clients for the year ended 30th June 2023. The company has followed generally accepted accounting principles and had a conservative approach to recognize revenue from its software application sales. Revenue was recognized only when the product was delivered to the customer. Due to increased competition leading to a decline in market share, the CEO of the company has put pressure on the Chief Finance Officer to find ways to improve the company's financial performance and boost revenue numbers. In reacting to the pressure, the CFO decided that the new policy will be that revenue from software application sales could be recognized as soon as the contract was signed, regardless of the product's actual delivery to the customer. The CFO did not disclose the change in policy. With the new policy, the company started to recognize revenue from software application sales immediately after contract signing, artificially inflating the company's revenue figures. This allowed the company to present a more favorable financial status, potentially increasing the share price and attracting new investors. Required, with reference to the above scenario, describe 3 circumstances under which a change in accounting policy is permissible. Roman 2, summarize 3 disclosures that could be made in the financial statements regarding the change in accounting policy. Roman 3, discuss 5 audit procedures that are necessary where an entity has changed an accounting policy. We're first going to answer part A, circumstances under which a change in accounting policy is permissible. We've read here that the accountant changed the accounting policy, but that was not disclosed. All right. The CEO did not disclose the change in the policy. So what are the circumstances under which a change in accounting policy is permissible? One circumstance is to comply with the change in new standards or interpretations. So a policy may be changed if there is any new standard or interpretation which a company needs to comply with. So we can say compliance with new regulations or standard, new accounting standard or interpretation. If there is any new interpretation to the accounting standards, or if there is any new accounting standard. So if there is new accounting standard or interpretation, then the company may change an accounting policy in order to do what? To comply with the new accounting standard. Compliance and new standard or interpretation. Now, if a new accounting standard or interpretation is issued, a change in policy may be necessary to adhere to the updated accounting principles. 2, improved presentation. This may also necessitate change in the accounting policy. Improved presentation of financial performance. This is a circumstance that can necessitate change in accounting policy. Improved presentation of financial performance. If the current policy is considered misleading or unreliable in representing the financial performance of the company, then a change can be made for improved financial performance of the company. A change can be made for improved financial statement presentation. The third point is correction of error. This is yet another circumstance that necessitates change in accounting policy. If a past policy was applied incorrectly, resulting in misstated financial statements, then a change is required to correct the error and also present accurate financial information. So these are 3 circumstances under which a change in accounting policy is permissible. 3 marks. 1, 2, 3. 3 marks. Roman 2, summarize 3 disclosures that could be made in the financial statements regarding the change in accounting policy. Disclosures that could be made. Roman 2, disclosures that should be made or could be made in financial statements regarding change in accounting policy. What are the disclosures? One is nature of the change. One is to disclose the nature of the change. This is required to be disclosed in the financial statements. Nature of the change. Clearly explain the specific accounting policy that has been changed and the nature of the new policy being adopted. That means clearly disclose the old policy and the new policy. Clearly explain the specific accounting policy that has been changed. That is the old policy. And also the nature of the new policy being adopted. The second disclosure is justification of the change. What are the reasons for the change? Justify. Provide rationale for the change, explaining how it improves the presentation of financial performance, and also you ought to provide more relevant information to users. Why is the change being made? That's obvious, is it not? Then what is the financial impact of the change? If there's a change in accounting policy, for example, the policy on depreciation, what will be the impact of such change on the financial statements? In disclosing, the accountant ought to quantify the financial impact of the change on current and future periods, including income, expenses, the assets, including liabilities, and so on. What is the impact of this change on assets, liabilities, and expenses? And that may involve comparative statements showing the effect of both policies. So candidates were to give 3 disclosures that could be made in the financial statements regarding the change in the accounting policy. 3 marks. 1, 2, 3. 1, 2, 3 marks. We are moving on to answer part Roman 3. Discuss 5 audit procedures that are necessary where an entity has changed an accounting policy. Now, if a company changes an accounting policy, what audit procedures should you perform as an auditor? That's what we want to discuss. Audit procedures that are necessary where an entity has changed an accounting policy. Audit procedures that are necessary. Audit procedures that are necessary for policy change. The first procedure is review of documentation. Review of documentation. The auditor ought to examine the official policy statements, the board minutes, the management memos, in order to understand the rationale and the decision-making process behind the change. You understand? Review of documentation surrounding the policy change. Another procedure is to reassess the accounting records. Reassessment of the accounting records. This may include recalculation of financial statements under both the old and the new policies to assess the materiality of the change and to ensure proper application of the new policy. So the auditor may compute, for example, if there's a change in the depreciation policy, the auditor may calculate the net income of the company under the old policy and the new policy, then compare the two to find out if there is any material difference as a result of the change. Reassessment of accounting records. It may include recalculating the financial statements, items, and so on. Testing of internal controls is another audit procedure. Testing of internal controls. Testing of internal controls. The auditor ought to evaluate the effectiveness of internal controls over new revenue recognition procedures to determine the risk of errors or intentional misstatements. 4. The fourth audit procedure is to do what we call independent verification. Independent verification. The auditor should confirm the existence and also the validity of contracts claimed as basis for revenue recognition before signing. You understand? The auditor can also perform analytical procedures to identify unusual patterns or inconsistencies in revenue trends. This may include the calculation of ratios and so on, analytical procedures. Disclosure. This is another procedure in relation to disclosure. We can call it disclosure evaluation. Evaluation of disclosure in relation to the policy change. Assess the adequacy and the completeness of disclosures made regarding the policy change in the financial statements and notes. So these are 5 audit procedures. 5 audit procedures, 10 marks. 1 is review of documentation. 2, reassessment of accounting records. 3, testing of internal controls. 4, independent verification. 5, disclosure evaluation. So candidates, by carrying out these audit procedures, the auditor can ensure that the change in accounting policy is justified, it is properly applied, and also adequately disclosed, upholding the integrity and the reliability of the financial statements. You understand? So that is what ought to have, what the auditor ought to do, because remember, this question is being set on the from the background of the scenario that has been provided, and this analysis candidates helps or highlights the ethical concerns surrounding this company, CompuMax Limited, change in the revenue recognition policy, and also the crucial role of the auditor in identifying and addressing such instances to maintain a fair presentation of financial statements. You will recall that the company has been following generally accepted accounting principles and had a conservative approach to recognition of revenue. And here we read that revenue was recognized only when the product was delivered to the customer. But there has been increased competition leading to declining market share, and the CEO has put pressure on the chief finance officer to find ways to improve the company's financial performance and boost revenue numbers. So what does the CFO do? The CFO decided that he should change the policy for revenue recognition, where sales would be recognized as soon as the contract was signed, regardless of the product's actual delivery to the customer. So, and the CEO did not disclose the change in policy. That's why I say that this analysis highlights the ethical concerns surrounding CompuMax change in revenue recognition. The CFO did not disclose the change in policy. And we read that with the new policy, the company started recognizing revenue from software application sales immediately after contract signing, artificially inflating the company's revenue figures. Artificially inflating the company revenue figures. So that's why, as an auditor, additional audit procedures ought to be carried out, and we've highlighted 5 such audit procedures. Now that is part A of the question. Part B of the question reads, the question on whether a change constitutes a change in policy or change in estimate has been a major source of discussion among accountants and auditors. Distinguish between change in accounting estimate and a change in accounting policy. We are going to have the distinction in form of a table. First column will be basis for distinction. Then you'll have change in accounting estimate. Now, candidates, when faced with a question that requires you to distinguish between two things, it is advisable that you have the distinction in form of a table for easy presentation, better presentation. So we are going to distinguish between change in accounting estimate and change in accounting policy. Right? The difference, candidates, between change in accounting estimate and change in accounting policy can be, we've read from the question, it has been a basis for discussion. It's been a major source of discussion among accountants and auditors. So what's the difference between change in accounting estimate and change in accounting policy? Sometimes, candidates, you can distinguish phrases or terms based on definition. What does change in accounting estimate entail? Now, change in accounting estimates adjusts the carrying amount of an asset or liability. This one adjusts the carrying amount of an asset or liability. Change in accounting estimate adjusts the carrying amount of an asset or liability or related expense. You understand? Let me say, or related expense. And this change is based on, could be based on updated information or reassessment of future benefits or obligations associated with that item. And an example is revising the estimated useful life of an asset based on its current condition or industry trends. So if an asset was estimated to have a useful economic life of, say, 10 years, the company may decide to change that estimate of 10 years to, say, 5 years. and that may be as a result of new information, that may be as a result of the current condition or industry trends regarding that estimate. So that is the meaning or what change in accounting estimate entails. It entails adjusting the carrying amount of an asset or liability or related expense. I've given an example of adjusting the estimated economic life of an asset, because that's an estimate. When you say that an asset is likely to have an economic life of 15 years, that's an estimate. So that estimate can be changed depending on the current condition of the asset. Now, change in accounting policy fundamentally alters how a specific type of transaction, event, or condition is accounted for in the financial statements. Alters how a specific type of transaction, this one alters how a specific type of transaction, it could be a transaction or even event or condition, event or condition is accounted for. Change in accounting policy alters how a specific type of transaction, event, or condition is accounted for in the financial statements. An example could be switching from the straight line method of depreciation to, say, the accelerated depreciation method or the reducing balance method or any other method, because that is a policy on how. So that could be an example. So this one alters how specific type of transaction, event, or condition is accounted for in the financial statements. So that's the distinction between change in estimate and change in accounting policy based on the definition. So we have distinguished the two on the basis of their definition. You understand? Another basis for distinction could be application. 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 Now, generally, candidates, change in estimates are applied prospectively. Change in an accounting estimates is applied prospectively, generally. Change in accounting estimates are applied prospectively. Are applied prospectively. What does that mean? That means that such a change has an impact on the future periods only, and the existing financial statements remain unchanged. Existing financial statements remain unchanged. Change in accounting estimates only affects future periods. How about change in accounting policy? Now, here the change is applied retrospectively. It is applied retrospectively. applied retrospectively. The change is applied, change in accounting policy is applied retrospectively. This one goes back to prior periods, right? It restates prior financial statements to reflect the new policy. It does what? Restates prior financial statements. Restating prior financial statements to reflect the change in the accounting policy. This one looks to the future, and the existing financial statements remain unchanged. That is the second distinction. You understand? This is the second distinction based on application. The third one is based on justification. Justification or the rationale for change. The change in accounting estimates is made when new information is available. Availability of new information. New information becomes available or existing estimates prove inaccurate. Where new or where the existing estimates prove inaccurate, then that necessitates change in accounting estimates. You understand? Where the current estimate leads to inaccurate financial statements, then there is justification or rationale for change. That's the rationale. But for change in accounting policy, the rationale for change in accounting policy is to improve comparability and consistency. You have to give how many distinctions? These are 4. I've given you 3. You have to give 2. I've given you 3. Now, for change in accounting policy candidates is to improve comparability, to improve consistency, and what we call representational faithfulness. Representation of faithfulness of the financial statements, because as we know, one key qualitative feature of financial statements is faithful representation. So it may be necessary to change accounting policy, the rationale being to improve comparability, consistency, and representational faithfulness of the financial statements. That's why this change is applied retrospectively, so that there is consistency. If a company chooses to change, for example, the depreciation policy on depreciation in 2023, the company may be required to adjust prior financial statements to reflect the new change, so that there could be comparability, consistency, and representational faithfulness of the financial statements. So that's it for question 3. We've answered Part A, which had Roman 1, 3 marks, Roman 2, 3 marks. Then there is Roman 3, how many marks? Roman 3, these are 10 marks. Then there is the part B of the question, distinguish between change in accounting estimates and change in accounting policy. We've distinguished the two based on definition, 1 mark, 1 mark. Application, change based on application, 1 mark, 1 mark. Then we have made another distinction based on justification or rationale for change. This is 1 mark, 1 mark. So any two distinction or differences here would earn the candidate 4 marks. Any 2 points here would earn you 4 marks. Another justification could be disclosure. So there are many differences. Disclosure. And both needs disclosure, but the extent of disclosure is dependent on the extent of the change. So these are 20 marks. We've answered question 3, December 2023, Advanced Auditing and Assurance, that was done by the CPA Advanced Level candidates. Thank you for attending the lesson. I'm going to answer this 4th question in our subsequent lesson, next lesson. But before you attend the lesson, please do the question on your own so that when you are answering the question here on the board, we compare notes. That's the best way to revise. Bye-bye. Hello everyone, and welcome back to the revision of the Advanced Auditing and Assurance paper that was done in December 2023. We, in our last lesson, did question 1. Today, we move on to question number 2. Part A of this question reads, the following is an extract from a speech presented in a recent professional forum. First paragraph reads, in the private sector, going concern is an area of interest to users of financial statements. Shareholders and lenders wish to know that a business will continue into the foreseeable future before they can make investment or lending decisions. Paragraph 2. The going concern concept in the public sector differs from that in the private sector. This is because most public bodies, whether government departments, devolved administrations, local public bodies, or national funds, have a statutory existence that makes technical insolvency almost impossible. Lastly, the last paragraph, despite that, stakeholders in the public sector still have an interest in knowing whether these institutions are financially sustainable. Required, in the context of the above statement, discuss 8 factors that an auditor would consider in determining the going concern assumption of a public entity. So we've read that in the private sector, going concern is an area of interest to users of financial statements, and shareholders and lenders wish to know that a business will continue into the foreseeable future before they can make investment or lending decisions. The second paragraph says that the going concern concept in the public sector differs from that in the private sector. This is because most public bodies, whether government departments, devolved administrations, local public bodies, or even national funds, have a statutory existence that makes technical insolvency almost impossible. Despite that, shareholders or stakeholders in the public sector will still have an interest in knowing whether these institutions are financially sustainable. Required, in the context of the above statement, discuss 8 factors that an auditor would consider in determining the going concern assumption of a public entity. Now, candidates, while technical insolvency may be less likely in public entities, their going concern can still be impacted. So the question is, what are some of the factors that an auditor should consider when assessing the going concern assumption for public bodies? That is the question we are going to answer first. Part A. Factors that an auditor should consider in determining the going concern assumption. Now, the first factor to consider is government funding. The government funding reliance. Government funding reliance. What does that mean? That means that the entity's dependence on government funding and stability of such funding plays a key role. And significant funding cuts or uncertainties can threaten the ability to continue in operation. So when determining whether a public entity will continue operating in the foreseeable future, to determine the going concern assumption of a public entity, the auditor should check government funding reliance, such that if there is significant funding cuts for a given public entity or department, then that department is likely not to continue in operating in the foreseeable future. Do you understand? Government funding, because without funding, organizations or departments cannot operate. So the going concern may be threatened for an organization or a department or an entity of government where there are significant funding cuts. 2, financial sustainability. The auditor can consider financial sustainability. The auditor should assess the entity's long-term financial position, including operating margins, debt levels, and also cash flow, because unsustainable financial practices or inability to generate sufficient revenue may raise concerns or may affect the going concern of such an entity. Financial sustainability ought to be considered by an auditor when determining the going concern of an entity. 3, legislative changes. Legislative or regulatory changes. Changes in laws, changes in regulations should be considered. These are potential changes in laws, regulations, changes in accounting standards should be considered. These are changes that may impact the entity's operations or funding. And therefore, unexpected changes can disrupt financial stability of a government entity. 4, public policy priorities. Public policy priorities. The auditor should analyze how changes in government priorities or public policies may affect the entity's funding or mandate, because shifting priorities could lead to reduced resource allocation, jeopardizing operations of a government department or institution. Public policy priorities can be considered when determining the going concern assumption in the public sector. 5, the economic environment the social environment should be considered. Social, economic and social environment. Economic and social environment. The auditor ought to assess the impact of the broader economic and also social factors like economic downturns, social unrest, natural disasters, which can disrupt operations and reduce demand for services that are offered by a given public sector entity. 5 or 6, this is 6. Operational efficiency and effectiveness. How effective is the entity? How efficient is the entity? Operational efficiency and effectiveness. The auditor ought to evaluate the entity's efficiency in using resources and achieving its objectives, because inefficiencies or failure to deliver on mandates can affect public support and future funding. So if an auditor is to determine the going concern of a given public sector entity, then he may, or the auditors may have to evaluate how the entity utilizes resources. So if there are wastages and inefficiencies, or if the entity fails to deliver on mandate, then that can affect future funding. Operational efficiency and operational effectiveness. 7, management, plans, and strategies. What are the strategies of the public sector entity? What are the strategies? What are the plans? Does the organization have plans? Does it have strategies? That should be considered. The auditor should analyze the entity's plans to address financial challenges, the plans to improve efficiency, or even to adapt to changing circumstances. Because robust and credible plans can mitigate the going concerns, the concerns of going concern. You understand? Management plans and strategies ought to be evaluated by the auditor. 8, public confidence. Does the public have confidence in the public sector entity? Or even stakeholder confidence and, let me say, and stakeholder support. Public confidence and stakeholder support. The auditor ought to check or consider the level of public trust and support for the entity, as it can influence future funding and political will to sustain the operations of such an entity. You understand? Because candidates, a loss of public confidence can impact budget allocations, can also impact legislative priorities. Okay? So these are 8 factors an auditor should consider in determining the going concern assumption in the public sector. So these factors highlight that although public entities have statutory protection, their going concern is not guaranteed, as much as there is a law in place that upon which public sector entities and departments are formed. That is not a guarantee that the public sector entity will continue operating in the foreseeable future. And auditors must thoroughly assess their financial sustainability, must assess the external environment, must assess the future plans that the organization has to provide an informed decision, so that the auditors can provide an informed opinion on the ability of the entities to continue as a going concern. So these are 8 factors. 1, government funding reliance. 2, financial sustainability. 3, legislative and regulatory changes. 4, public policy priorities. 5, economic and social environment. 6, operational efficiency and effectiveness. 7, management plans and strategies. 8, public confidence and stakeholder support. So all these factors can affect the going concern of any public sector entity. And therefore, when the auditor is carrying out his or her audit, he must consider these factors in determining whether an entity is a going concern or not. That is question 2A. Question 2B reads, describe 4 procedures that an auditor might perform to identify subsequent events occurring after the financial year end in a company. Procedures an auditor should perform. What are the procedures for identifying subsequent event? What should the auditor do to identify subsequent event? What are the procedures? 1 is to inquire from management. Inquiry, right? Inquiry of management. This means just talking to the management, asking questions. Ask questions regarding subsequent events, because managers are the ones who are in charge with the operations of an organization. So if an auditor would want to identify subsequent events, then it becomes obvious. Talk to the management. Discuss with the management whether any significant events occurred after the reporting date that may affect the financial statements. Why? Because the management has a responsibility to disclose such events. Discuss with the management. Ask questions. Inquire. Are there any subsequent events? So that is a procedure an auditor can perform to identify subsequent events. 2 is review of external sources. Review of external sources. The auditor can monitor news articles, industry publications, regulatory filings for any events impacting the entity or its sector after the reporting date. Review external sources, publications, newspapers, social media, industry publications, regulatory filings. That is one way to identify subsequent events. If the auditor does not get the information from the management, then he can seek for the same information from external sources. Performance of analytical procedures. Performance of analytical procedures. That's another procedure that an auditor can perform to identify subsequent events. This is the auditor can perform analytical procedures by comparing the key financial ratios to identify any trends with to identify the trends with prior periods. The auditor can also perform or can also compare the company's financial ratios with industry benchmark, and any unexpected changes between industry between the financial ratios of the company and the benchmark, the industry benchmark, or between the company and previous periods. Any unexpected ratios could indicate the occurrence of subsequent events. Perform analytical procedures. 4, follow up audit follow-up audit procedures. Follow-up audit procedures. The auditor can perform additional audit procedures specific to areas that are identified as risky or areas that have a potential for subsequent events. And that may involve rechecking accounts receivables or confirming bank balances, accounts payables, and so on. So these are 4 audit procedures that the auditor can perform in order to identify subsequent events. And by implementing these procedures, auditors can identify and appropriately address subsequent events that may affect the accuracy and the completeness of the as well as the reliability of the financial statements. 4 procedures, 8 marks. 1, 2, 3, 4, 8 marks. That is part B of the question. Part C reads, your audit firm KKCO LLP has been the auditor of Express Limited, a leading online retailer that was established a few years ago. At inception, the company had an average delivery time of a week, but has since grown to an average delivery time of between 1 and 5 days. The company started with 3 employees and has grown to 1,000 employees, including 150 customer service team who are available 7 days a week. It has emerged that an employee stole 20 million shillings by manipulating vendor payment records, pointing to the risk of fraud facing their trading platforms. Required, prepare a proposal to the directors of Express Limited explaining Roman 1, the need for an internal audit function in the company. Roman 2, the benefits of outsourcing the internal audit function. So you are to prepare a proposal, and the basis of the proposal is 1, the need for an internal audit function in the company and the benefits of outsourcing the internal audit function. So this is a proposal from the auditor to the company, which is known as the Express Limited. All right. Part C required candidates to prepare a proposal for establishing an internal audit function. Prepare a proposal to the auditors explaining the need for an internal audit function in the company and the benefits. So the proposal is this is a proposal to Express Limited. Then you can have the address there. So this proposal is to the Express Limited, and it is from the auditors. These are auditors. The name of the auditors, KKCO LLP. Then you have the address. Proposal to Express Limited from KKCO LLP. These are auditors. You understand, countries? Then you may have the date there. The date. Because we have dates. The date can have the date, any date, teacher's date. Then you have the subject, which you can say establishment of the audit function. Establishment of the audit function. Establishment of internal audit function should be internal audit function. Let me have it. Establishment of internal audit function. That's the subject of the proposal. Establishment of an internal audit function. Then candidates, we may have 3 sections or 2 sections within this proposal. We may have an executive summary, but looking at the marks candidates, this is for knowledge, but an executive summary may not be a must. What is important in this proposal is to capture the need for an audit function and the benefits of outsourcing the internal audit function. So you may have an executive summary where you highlight the problem that the company has had, because we've read that the Express Limited has experienced phenomenal growth in the recent past. It has experienced phenomenal growth. We read that the company initially had how many employees? The company started with 3 employees and has grown to 1,000 employees. So the company has experienced phenomenal growth in the recent years, expanding its workforce, expanding services. You can see, including 150 customer service team who are available 7 days a week. So that could be the introduction to this proposal, that the company has experienced phenomenal or substantial or significant growth in recent past, expanding its workforce, services, and delivery capabilities. We've seen it delivers within 7 days a week. And because of this rapid growth, we can say this rapid growth presents new opportunities and challenges, particularly regarding the internal audit function within Express Limited, to address the evolving needs and safeguard the company's financial health and operational efficiency. So that could be what you can write under the executive summary. You summarize the problem. Then another part of this could be what is required in the question, which is the need for an internal audit function. So you can write the need for an internal audit function. That's another part of the proposal, the need for an internal audit function. Now, candidates, as Express Limited scales, relying solely on external audits is insufficient. As the company scales, as the company significantly grows, then relying on the external audit function is not sufficient, and therefore an internal audit function offers invaluable benefits. So what are the benefits? What is the need? Why should the company establish an internal audit function? That's the question. The need for an internal audit function. The first reason why the company needs an internal audit function is to proactively identify risk and mitigate risk. Proactive risk identification and mitigation. Proactive risk identification and mitigation. Because we read that an employee stole 20 million. The company came to know about it later. But had the company established an internal audit function, there are chances that the company could have identified such loopholes and put in place mitigation against such risks. Risk identification and proactive risk identification and mitigation is a reason why there is need for an internal audit function in Express Limited. This refers to continuous internal audits proactively to identify vulnerabilities in the internal controls, preventing potential fraud, preventing errors, preventing inefficiencies before they become costly problems. That's one reason why the company needs to have an internal audit function. 2, an internal audit function can lead to improved governance and compliance. Improved governance and compliance, because internal audits ensure adherence to internal policies. The audits may also help in regulatory requirements, adherence to regulatory requirements, adherence to ethical standards, and thereby promoting strong corporate governance. That's why this company needs to establish an internal audit function so as to improve governance and compliance. 3, given that this company has grown from 3 employees to 1,000 employees, an establishment of an internal audit function can lead to enhanced operational efficiency. Enhanced operational efficiency. That is the role of an internal audit function. How does establishment of an internal audit function lead to enhanced operational efficiency? This is how. Enhanced operational efficiency is achieved through regular audits, which analyzes processes and workflows. Regular audits analyzes processes, because we're talking about operational efficiency. It analyzes processes, it analyzes workflows. And out of that analysis, the audits identify opportunities for improvement and streamlines operations for increased cost effectiveness. This company needs an internal audit function for increased operational efficiency. Another reason is in relation to financial reporting. Financial reporting. internal audit function strengthens financial reporting reliability. This is D. It strengthens financial reporting reliability. How? Because candidates, internal audits enhance the accuracy and the reliability of financial reporting by verifying data and assessing internal controls over the financial systems. You understand? Strengthens financial reporting reliability. This function may also give what we call independent assurance and objectivity. Independent assurance and objectivity. Internal auditors provide an independent perspective on the effectiveness of the internal controls, complementing the external audit findings. That's why this company needs to establish an internal audit function. So we've answered the first part of the question. One, the need for an internal audit function. The second part of the question required candidates to explain the benefits of outsourcing the internal audit function. Now, candidates, there are two ways in which the internal audit function can be established. One is to this function carried out by the employees of the company. Alternatively, the company can outsource this function from external auditors. So what are the benefits of outsourcing? That is the question. Benefits of outsourcing. Now, candidates, while establishing an in-house internal audit team is valuable, outsourcing may also offer several advantages. The first advantage is cost efficiency. Cost efficiency. Outsourcing eliminates the need to recruit, eliminates the need to train, and also to manage a dedicated internal audit personnel. And that reduces fixed costs, and also it offers flexibility based on evolving needs. This is a benefit of cost efficiency. B, access to expertise. Outsourcing may provide the company with access to expertise. Outsourcing provides access to experienced and qualified internal audit professionals who may have diverse industry knowledge or skills and so on. So by outsourcing, the company can have access to wide range of internal audit professionals who may have industry knowledge that the company may not have if it were to have an in-house audit team. 3, objectivity and independence. Objectivity and independence. External internal auditors bring an objective and independent perspective which is free from potential bias within the organization. 4, scalability. Scalability. Now, outsourcing allows for scaling the internal audit function as needed without incurring additional fixed costs during periods of growth or during periods of contraction. So we have scalability. Lastly, flexibility. Flexibility. Choosing an external audit choosing to outsource the internal audit function can lead to flexibility. It offers flexibility in tailoring services to address specific risks, to address specific priorities, and also to maximize the value of the internal audit efforts. So these are 5 benefits of outsourcing the internal audit function. So you recall candidates, in these questions, candidates were to develop a proposal to Express Limited as KKCO auditors. The subject of this proposal is establishment of internal audit function. Then I began by saying that when doing a proposal, it's good to have a brief introduction, what we call an executive summary, where in this case the candidates or the auditors are to highlight the reason for having the proposal. And we said that because the company has grown significantly in the recent past from 3 employees to 1,000 employees, and given that the company is experiencing challenges where an employee stole 20 million, then there is need to have internal audit function. And in this question, we have highlighted 4 reasons for the need for having an internal audit function. That is proactive risk identification and mitigation is the first reason. Improved governance and compliance, number 2. This function can also enhance operational efficiency. Number 3, may strengthen financial reporting reliability. The function can also give rise to independent assurance and objectivity. Then the question required candidates on to highlight the benefits of outsourcing the internal audit function. We've seen one benefit is cost efficiency, access to expertise. Then there is objectivity and independence, scalability and flexibility. Within this proposal, candidates, you may have recommendations from the auditors to Express Limited. And the auditors can strongly recommend establishing an internal audit function at Express Limited. You can write that we believe outsourcing this function provides the most effective, the most cost-effective and advantageous option given the current stage of growth the company is going through. And under recommendations, the auditors can state that they can assist in selecting a qualified and reputable internal audit outsourcing provider with proven experience in e-commerce and retail sector. So that could be the recommendations. One is to recommend the establishment. The auditors recommend one, establishment of an internal audit function. Then under recommendations, the auditor can volunteer in assisting in selecting qualified and reputable internal audit function. I've mentioned about outsourcing as another recommendation. You understand? Outsourcing the function may be more cost effective. Outsourcing. The auditors can recommend you outsourcing, and also 3, assisting. in identifying internal auditors. Then you close the proposal. Thank you. Thank you. Sincerely yours. Then you sign. But candidates where the marks were mainly allocated under these two categories, because these are only 4 marks for each. These 4 marks. Any 4 points here would earn 4 marks. Any 4 points here, 4 marks. That is the body of the proposal. You may miss on recommendations and even these other aspects, but when answering such a question in an exam, make sure you give the answers as required. Roman 1, the need for an internal audit function in the company. We've identified the need. Then the benefits, you have given the benefits. So that is it for question 2, December 2023, Advanced Auditing and Assurance. Thank you for attending the lesson. We'll meet in our next session where we will answer question number 3. And please attempt the question before joining the next class. Bye-bye. Hello everyone and welcome to the lesson. The subject is Advanced Auditing and Assurance. Today we are going to start revising the paper that was done in December 2023 by the CPA Advanced Level candidates. This question paper has 5 questions. Candidates were required to answer all questions, and we will be answering a question at a time. In our today's lesson, we'll answer question 1. In our next session, we'll answer question 2 until we complete the 5 questions. I urge you to attempt the questions before attending these lessons. Make sure you do the questions on your own before coming to this revision session. So let us begin by answering question number 1, which reads, Part A, you are the audit manager of Baraka and Company LLP, who are the auditors of Miradi Limited for the year ended 30th June 2023. The company has net assets of 150 million. The audit has been completed, but there is a matter that has not yet been resolved on depreciation of buildings. The directors of Miradi have resolved that depreciation on buildings will not be provided for in the financial statements. The buildings were acquired in the year 2020 and no depreciation has been provided since. Required Roman 1, describe 6 additional audit procedures and actions that you would take with respect to the above matter. So candidates, here is a problem with the Baraka, Miradi Limited. This is a company that whose net assets are valued at 150 million. But the item on depreciation, we learned that depreciation has not been provided for on buildings since the buildings were acquired in the year 2020. Candidates were required to describe 6 additional audit procedures and actions that could be taken in respect to the above matter. So let us put down the audit procedures, additional audit procedures. This is December question 1. A, Roman 1. What are the additional audit procedures that the auditor should perform in respect to buildings. Now, candidates, the first audit procedure is to review the accounting policies. The auditors should review the accounting policies of this company, the Miradi Limited company. The auditors should conduct thorough review of Miradi Limited's accounting policies related to depreciation, specifically focusing on the treatment of buildings. The auditor should evaluate, in carrying out the review, the auditor should evaluate the consistency of the policies with applicable accounting standards and also the regulatory requirements. Review of accounting policies, because candidates, every company must have accounting policies on different matters. For example, on the estimation of depreciation, company must have accounting policies in relation to depreciation. And therefore, given that there is a problem on the buildings, we've read that the audit has been completed, but there is a matter that has not been resolved on depreciation of buildings. So as the auditors ought to review the accounting policies related to buildings. And in reviewing the accounting policies on buildings, the auditor should evaluate the consistency of the policies with respect to accounting of or treatment of the depreciation on buildings. 2, assessment of the methodology on depreciation. Assessment of depreciation, let me call it depreciation methodology. The auditor should assess the methodology on depreciation. The auditors ought to evaluate the appropriateness of the depreciation method that is applied to buildings. This means assessing whether the straight line method is reasonable or any other method of depreciation. So there are the various methods that the company may use. The straight line method or reducing balance method. So the auditor should evaluate the appropriateness of the method that is used to depreciate buildings. Assess, for example, whether straight line method is reasonable or not. The auditors may also consider alternative methods and their potential impact on the financial statements. There are various methods: the reducing balance method, the straight line method, and so on. Assessment of depreciation methodology. 3 is another audit procedure is in relation to documentation. Inspection, let me call it inspection. The auditor should inspect the documentation related to buildings, of building documentation. Inspection of building documentation. The auditor ought to physically inspect the documentation related to buildings, including purchase agreements, title deeds, and any other relevant contracts. And by so doing, the auditor can verify the accuracy of the acquisition costs and also ensure that no impairment or changes in the useful life have occurred since acquisition. inspection of buildings documentation. You understand? That is, if the building was bought, then there has to be agreements. If the buildings were constructed, then there are documents related to construction of buildings. So the auditor should inspect the documentation related to buildings. Whether the buildings were bought or even constructed by the company, there are various documents that ought to be inspected, like the title deeds, the relevant contracts, the purchase agreements, and so on. So candidates, we are discussing the additional audit procedures that the auditor should carry out in relation to building of Miradi Limited, a company that has refused to depreciate buildings. We read from the question that the audit has been completed, but there is a matter that has not yet been resolved on depreciation of buildings. The directors of Miradi Limited have resolved that depreciation on buildings will not be provided for in the financial statements. So what audit procedures, additional audit procedures, should the auditors perform? The fourth audit procedure is evaluation of maintenance expenditure. You understand? Evaluation of maintenance expenditure or expenditures. The auditor should evaluate the maintenance expenditures. The auditor should review the company's records of maintenance expenditure that is incurred on buildings since acquisition. We saw that these buildings were bought in the year 2020. The auditor is carrying out the audit in the year 2023. So since 2020, what are the maintenance costs related to buildings? The auditor should assess, should evaluate, should review the company's records of maintenance expenditures incurred on the building since acquisition in the year 2020. The auditor should assess whether there are significant repairs or whether there have been improvements that have been capitalized, or whether there are any improvements since the buildings were acquired. Assess whether any significant repairs or improvements have been capitalized, and whether the expenses have been appropriately distinguished from maintenance costs. You understand? Because there are certain costs that are incurred on buildings that ought to be capitalized. Other expenses on buildings may be part of the normal expenses of for the company. So that assessment has to be done, and the auditor can only do that after evaluation of the maintenance expenditures. 5, comparison. The auditor can do a comparison with industry standards. What are the industry standards? That means that the auditor should do what we call benchmarking. Benchmark the company's depreciation policy and practices against industry standards and norms, and consider factors such as the average useful life of the buildings in the industry sector, and also the common depreciation rates used by peer companies. So this is Miradi Limited. We are not been given information on the industry in which this company operates, but whatever industry it is, whether it is a banking industry or agriculture industry or whatever industry, the auditor should benchmark the practices within the industry vis-a-vis what the company is currently doing in relation to buildings. What are the depreciation policies? What are the practices in the industry? and what are the standards, what are the norms in the industry compared to what the company is doing, because industries may have certain average useful life for buildings. The companies may have a common depreciation rates that are used within that industry. So the auditor should compare the rates, should compare the the various factors in relation to buildings compared to what happens in the industry. So comparison with industry standards. So this is an additional audit procedure. Another procedure is in relation to communication with third parties. Communication with third parties. These third parties could be experts or independent appraisers, industry experts, and so on. The purpose for this procedure is to obtain their opinion on the appropriateness of the company's depreciation policy and the condition of buildings. Do you understand? These are third parties, like experts, appraisers, and so on. Communication with third parties. Industry experts. So these are some of the audit procedures. They are not the only audit procedures. There are more. There could be more, but these are 6 audit procedures that the auditor can perform in relation to the buildings of Miradi Limited Company, which has not been providing for depreciation on buildings for the last 3 years. So the auditor here, I'm saying, should seek validation or additional insight to support audit findings. So these additional procedures candidates aim to enhance the auditor's understanding of the depreciation matter. These audit procedures may also help the auditor assess the impact of the decision not to provide for depreciation on the financial statements, and also to ensure compliance with accounting standards and regulatory requirements. That is the solution to that part. Additional audit procedures: number 1, review accounting policies. Number 2, assessment of depreciation methodology. Number 3, inspection of buildings documentation. Number 4, evaluation of maintenance expenditures. Number 5, a comparison with industry standards. Then lastly, communication with third parties. That is part A, Roman 1. A, Roman 2, assume that according to your workings, the depreciation charge on buildings for the year ended 30th June 2023 should be 4.2 million based on the straight line method of depreciation at an annual rate of 5%. Required, discuss the implications of the above on the financial statements, clearly indicating its effect on the audit report. This is Roman 2. We have to discuss implications of the above on the financial statements. The above is assuming, according to your workings, the depreciation charge on the buildings for the year ended 30 June 2023 should be 4.2 million on the straight line method depreciation at an annual rate of 5%. What is the implication of this? What is the implication if the depreciation was to be 4.2 million? What is the implication on the financial statements? This question is in 2 parts. Implication on the financial statements, then clearly indicating its effect on the audit report. We'll also discuss the effect of this information on the audit report. But first of all, let us discuss implications on the financial statements. Failure to provide for depreciation on buildings. despite being required by accounting standards candidates, has several implications on the financial statements and consequently on the audit report. So what are these implications on the financial statement? The first implication is overstatement of assets. Overstatement of assets. Now, since depreciation represents the systematic allocation of the cost of an asset over its useful life, not recognizing depreciation results in overstatement of the carrying amount of buildings on the balance sheet. And in that case, the building's value would remain at their original acquisition cost, leading to an inflated asset value. So ideally, depreciation is to reduce the cost of the building. But if depreciation is not charged, then the assets will be overstated. The asset will be overstated. We read from this question that the company has a net asset of 150 million. This is a total value of assets. That tells you that the value of 150 million is overstated because of the fact that the company does not provide for depreciation. And if this company has not been providing for depreciation for the last 3 years, and we have read in note number 2 that the depreciation charge, the auditor may have carried out this depreciation to be 4.2 per annum. If the depreciation charge is 4.2 per annum, and this company has not provided for depreciation for the last 3 years, you can see, candidates, the depreciation charge, the accumulated depreciation is 12.6 million. So that means that the total value of assets, the net assets of 150 million is overstated by 12.6 million. That is the implication of not providing for depreciation on assets by this company. That's the first implication. The second implication is the overstatement of net income. The net income is overstated as well, because depreciation expense is deducted from revenue to calculate net income. And by not recognizing depreciation, the company's reported net income would be higher than it should be. And in this scenario, the absence of depreciation charge of 4.2 million would lead to the overstatement of net income, thereby distorting the profitability of the company. So for example, if the company recorded a net profit for this year of say 30 million, that means that net profit is overstated by 4.2 million. So that is the impact of not providing for depreciation on buildings. Number 3, distorted financial ratios. Distorted financial ratios. Now, the overstatement of assets and net income due to the omission of depreciation affects various financial ratios. For example, the return on assets ratio would be inflated, giving a false impression of the company's efficiency in generating profits from assets. Similarly, the debt to equity ratio could also be affected, as the inflated assets would lead to a lower leverage ratio. You may have other assets like the return on capital or return on capital employed, which is calculated by getting the ratio between the net profit and sales, or net profit and return on capital employed. So the omission to depreciate buildings could lead to distorted financial ratios. Why? Because the assets are inflated, net income is also inflated, and that could affect various financial ratios. That is an implication of not providing for depreciation on buildings. For misrepresentation of the financial position of the company, of the financial position of the company. Misrepresentation of the financial position of the company. Financial statements are meant to provide a true and fair view of a company's financial position. So failing to recognize depreciation results in misrepresentation of the company's true financial position by overstating assets and overstating profitability. And these misrepresentation candidates could mislead stakeholders, including investors, creditors, and even the regulators. So that is the fourth impact for not providing for depreciation on buildings. The question required candidates also to highlight the effect of this omission on the audit report. If I can take the question again, discuss the implications of the above on the financial statements. So these are the impacts on the financial statements, clearly indicating its impact on the audit report. Impact on audit report. What is the impact of this omission on audit report? Impact on audit report. Now, the auditor would need to issue a qualified or adverse opinion. The auditor may need to issue a qualified or adverse opinion. As a result of these effects of omission of depreciation of buildings on buildings, as a result of these effects or this omission of depreciating buildings has effect or impact on the audit report. One impact is that may lead to issuance of a qualified or adverse opinion. And that whether the auditor issues a qualified or adverse opinion depends on the materiality or the pervasiveness of the issue. And candidates here, a qualified opinion would be issued if the auditor concludes that the failure to recognize depreciation results in a material misstatement of the financial statements, but is not pervasive. On the other hand, an adverse opinion would be warranted if the auditor determines that the misstatement is both material and pervasive, meaning that it affects multiple areas of the financial statements. So that would be one impact. That may lead to issuance of a qualified opinion or adverse opinion depending on the materiality of and pervasiveness of the error. The audit report number 2 may also include a section discussing the basis for qualification or adverse opinion. There would be an additional paragraph the audit report would contain a section. You understand? Discussing the basis for qualification or for issuing an adverse opinion. And this section would explain the reasons for the auditor's conclusion, including the failure to recognize depreciation, including the impacts of this omission to depreciate buildings on the financial statements. It would also highlight the departure from accounting standards and regulatory requirements. Additional paragraph. There will be a section explaining the impact of this mistake on the and so on. So these are two impacts on the audit report. Now, candidates, in concluding this part of the question, we can say that the failure to recognize depreciation on building has significant implications for accuracy and reliability of the financial statements, requiring appropriate disclosure and also qualification in the audit report in order to inform the stakeholders of the limitations of the financial information that has been presented. So the auditor has a duty to inform the users of the financial statements of the failure by the management to depreciate buildings. Failure to recognize depreciation on buildings has significant implications for the accuracy and reliability of the financial statements. You've seen how the failure of this failure can lead to implication on the assets. It has implications on the net income. It has implications on financial ratios. It has also implication on the truthfulness and the fairness of the financial statements, because we know that financial statements are expected to portray a true and fair view. But if there is an omission in depreciation, that can lead to misrepresentation of the financial position, which means that the financial position of the company as presented by the management does not present a true and fair view. So that is question A, part 2 had 8 marks. 1, 2, 3, 4, 5, 6. Any 4 points there would earn you 8 marks. Part B, audit risks associated with audit of financial statements. Now, candidates, financial instruments, we all know, present unique challenges for auditors due to their complexity and due to their inherent risks. So what are some of the audit risks that are associated with the audit of financial statements? So if you are to audit financial statements, what are some of the risks that are associated with audit of the financial instruments? Not statements, but instruments. Audit risks associated with audit of financial instruments. The first audit risk is the valuation risk. Valuation risk. Now, financial instruments are often valued using their fair value estimates, which can be subjective and prone to error. So auditors need to assess the appropriateness of valuation techniques, and the auditors also may need to assess the underlying assumptions used by the management. So when auditing financial instruments, the auditors must pay attention to the appropriateness of the valuation techniques and also the underlying assumptions that were used by the management to value the financial instruments. So valuation risk is an audit risk associated with the audit of financial instruments. 2, model risk, model risk. Now, complex valuation models are sometimes used to determine fair value. And these models can be flawed or can contain errors leading to misstated financial instruments or even misstated financial statements. So auditors need to evaluate the control around model development and their use. So financial instruments are valued based on certain models. So there could also be errors in the development of these models, which can pose model risks. And when auditing these financial instruments, the auditors ought to pay attention to the models and the risks and how they are developed. There are also inherent risks associated with the audit of financial instruments. Number 3, inherent risks. Financial instruments are inherently risky due to factors like market fluctuations, factors like creditworthiness of the counterparts, and also liquidity issues. So the inherent risk associated with the specific instrument can be high, requiring extensive audit procedures. Inherent risks. 4, control risks. There are also control risks associated with the audit of financial instruments. The internal controls surrounding financial instruments may be weak, they may be ineffective, and that could allow for errors or fraud to go undetected. So auditors need to assess the design and also the operating effectiveness of controls related to financial instruments and also related to transactions around financial instruments and valuation. Control risks. Lastly, we have classification risk. There's also risk associated with classification. Financial instruments can be complex and may be incorrectly classified in the financial statements. And this misclassification can have a significant impact on the reported financial position and results. So auditors need to understand the classification criteria, and also they need to test the company's classification processes. Classification risks. There's also disclosure risk associated with the audit of financial instruments. Disclosure risk. The financial statements may not adequately disclose the nature and the extent of the risk associated with financial instruments. And insufficient disclosures candidates can mislead users of the financial statements. So auditors need to assess the completeness and the accuracy of disclosures related to financial instruments, like derivatives. So these are 6 audit risks. Candidates were to give 6 audit risks. 1 is valuation risk, 2 model risk, 3 inherent risk, 4 control risk, 5 classification risk, 6 disclosure risk. How many marks? These are 6 marks. 6 marks. Part A of the question, how many marks? This one, 6, this is a point here, 6 marks. Then we have 6 part 2, implication on financial statements, 6 marks. These are 8 marks. Any 4 points will earn you 8 marks here. Total is 20 marks. So that is a suggested solution to the Advanced Auditing and Assurance December 2022 question 1. Thank you for attending the lesson. In our next session, we are going to answer question number 2. So please attempt question number 2 before joining our next session. Bye-bye. Part B of question 4 reads, in conducting the audit of historical financial statements, the auditor's objective is to obtain sufficient appropriate audit evidence on which he forms an opinion about the financial statements as a whole and report that opinion to the shareholders. Required, describe the auditor's objectives when undertaking Roman 1, an examination of prospective financial information. Then 2, a financial due diligence assignment. So we are to describe auditor's objectives when undertaking Roman 1, an examination of prospective financial information. That is part B. Roman 1 is objective when undertaking the prospective financial information. But first of all, candidates, it's assumed that you know what prospective financial information is. So what is prospective financial information? Prospective refers to potential or future. So we are talking about future financial information. Potential, prospective, expected, and all that. So that is to say that prospective financial information refers to the financial data about future outcomes. Prospective financial information refers to financial data about potential future outcomes or future positions of an entity. It includes things like forecasts, budgets, projections, and any other forward-looking financial information that are based on assumptions about future events and management processes. And this information, candidates, is usually prepared to assist in decision-making processes such as strategic planning, investment analysis, fundraising activities, and so on. So that's the meaning of prospective financial information. But the question here is, what are the objectives? What are the objectives? That's the question. Describe auditor's objectives when undertaking an examination of prospective financial information. What are the auditor's objectives when undertaking an examination? When undertaking an examination of prospective financial information, you need to understand the question. You also need to understand the terms within the question before attempting to answer it. So what are the primary objectives of the auditor's examination of the prospective financial information? The first objective is to evaluate the reasonableness and the consistency of the assumptions and methodologies that are used in preparing the prospective financial information. 1, evaluate the reasonableness. Are the assumptions reasonable? Because we are saying that the prospective financial information is developed based on certain assumptions about future events. So are these assumptions reasonable? Are they consistent So one reason why the auditor examines, the objective of examining the prospective financial information is to evaluate the reasonableness and also the consistency of the data or assumptions, and also the methodologies used in preparing the PFIs. And that involves evaluating whether the assumptions are supported by reasonable and supportable data, or they are consistent with historical trends and are also in line with industry standards and economic conditions. So that is one objective: evaluate the reasonableness and consistency of the assumptions and methodologies used in developing the prospective financial information. Now, candidates, there are times when the auditor is required to audit the PFI. We are talking about forecasts, budgets, projections. That is what we refer to as the prospective financial information, and we've defined it as the financial data about the potential future outcomes. That is objective number one. Number two, assess compliance is to assess compliance. We are discussing the objectives. Another objective is to assess the compliance with, let me say, applicable framework. To assess compliance with applicable framework. That is number two. This was number one. Assess compliance with applicable framework. Now, the auditor's objective is to determine whether the prospective financial information complies with the applicable reporting framework or guidelines, such as those issued by regulatory bodies or by professional organizations. And that involves verifying that the information is presented in accordance with the required format, is presented in the required format, disclosures, and also presentation requirements. So that is yet an objective of examining prospective financial information. Assess compliance with applicable framework. Number three, the third objective is to evaluate the adequacy of disclosure. It is to evaluate the adequacy of disclosure. Now, the auditor here seeks to ensure that the PFI includes adequate disclosures regarding the underlying assumptions, the uncertainties, and the limitations that are inherent in forecasts or projections. Because remember, we say that PFIs are developed based on assumptions. So the auditor has to evaluate adequacy of disclosure of such assumptions. What are the uncertainties surrounding this information? What are the inherent limitations? Because we are dealing with future outcomes, assessment of future outcomes. PFIs are developed like things like budgets, projections, forecasts. They are developed based on certain assumptions. So when the auditor carries out an examination, then he's to evaluate the adequacy of disclosures of these assumptions, the limitations, and so on. And that includes assessing whether the disclosures provide users with the sufficient information to understand the basis for prospective financial information and the key factors that may impact its reliability. Evaluate adequacy of disclosures. Another objective is to assess the reliability and completeness of supporting documents. When preparing budgets, when preparing forecasts, when preparing prospective financial information, then there are supporting documents that the management may rely on. And here, the auditor will aim to verify the reliability and also the completeness of the supporting documents that are used in preparing the PFIs. And that involves examining the underlying data, examining the models, examining the calculations, and also other parameters in order to ensure the accuracy, their completeness, and also integrity of such tools. That is objective number 4, assessing reliability and completeness of supporting documentation. The 5th objective is the consideration of independence and objectivity. Consideration of independence and objectivity. Now here the auditor must maintain independence and objectivity throughout the examination process, and that includes assessing any potential threats to independence, any potential threats to objectivity, and also taking appropriate measures to mitigate or to eliminate such threats to ensure the integrity and credibility of the examination. So these are 5 points, objectives when undertaking PFI, examination of PFI. So I repeat to help understand that PFIs, these are financial data like budgets, and companies may be forced to prepare such information for users like banks. The bank may want to know what are the forecasts of a company in terms of cash flows before they lend money to a company. So when the business prepares budgets, before the bank relies on such budgets and forecasts, the auditor may be called upon to audit the prospective financial information and give an opinion. So when auditing, the question is, describe the auditor's objective when undertaking an examination of prospective financial information. So when auditing, the auditor is to check or evaluate the reasonableness and the consistency of assumptions and methodology that are used in the preparation of the PFIs. Number 2 is to assess compliance with applicable framework. Number 3, the auditor evaluates the adequacy and disclosure. Number 4, assesses the reliability and completeness of supporting documentation. And lastly, he considers his independence and objectivity. These are 5 objectives. Candidates were required to give just 3. I've given 5. Any 3 here would earn you 3 marks. Then another part of this question is describe the auditor's objectives when undertaking a financial due diligence assignment. Financial due diligence assignment. Roman 2. Financial due diligence assignment. Now, candidates, for the sake of knowledge, in part 1, another objective for carrying out examination of PFI, another obvious objective is to communicate findings. The objective of carrying out PFI is to communicate is to communicate his opinion. The auditor does not just carry out audit of PFI. The key objective here is to communicate his opinion or to communicate his findings after carrying out an examination of the PFI. The objective is to communicate their findings and opinion on the prospective financial information to the intended users, which may include shareholders, lenders, management, or even any other stakeholder. And the report, this opinion is contained in a report, in an audit report, which is a special report. It is not an audit, a report on the, it is not an opinion on the general financial statements, but is an opinion on the PFIs. You understand? The auditor's report should clearly state the scope of the examination, the basis for their opinion, and also any material findings or limitations identified during the examination of the PFI. So that is sixth objective. Now let's move on to financial due diligence assignment. This is also an auditor's assignment. An auditor may carry out an assignment we are calling financial due diligence. But before we answer this question, candidates, what is a financial due diligence? What is a financial due diligence assignment? That's the question. This is basically a comprehensive review and analysis that is conducted by a professional firm, such as an accounting or consulting firm, to evaluate the financial and operational aspects of a company. So it is a thorough examination, comprehensive examination of the financials of a company. And this assignment is typically performed in the context of mergers and acquisitions. It may also be conducted in the context of investments or any other strategic transactions where a thorough understanding of the target company is crucial. Understanding of the target company's financial health and also performance is crucial. For example, before a company acquires another one, there ought to be a financial due diligence that is carried out by a professional, an expert, so that the buyer or the acquirer understands the company thoroughly. So it is an assignment that is performed in the context of strategic transactions like mergers, acquisitions, investments, and so on. So a financial due diligence is a comprehensive review and analysis that is conducted by a professional. That is one. And the purpose for this review is to evaluate the financial and operational aspects of a company. That's the meaning of financial due diligence assignment. But what is the question? The question is, describe the auditor's objectives when undertaking a financial due diligence assignment. What are the auditor's objectives? One, I've given a hint. One is to assess the financial health of the company. Assess financial health and performance is to assess the financial health and performance of the company. Is to assess the financial health and performance. The auditor aims to assess the financial health and performance of the target company by analyzing its historical financial statements, including income statements, the balance sheets, the cash flow statements, the ratios, and so on. And that involves identifying trends, identifying anomalies, and any potential risks that may impact the company's financial stability and the future prospects. That's objective number one. Objective number two, to identify risks and opportunities. The purpose for carrying out a due diligence assignment, financial due diligence assignment, is to identify risks and opportunities. The auditor seeks to identify and evaluate the key risks and opportunities associated with the target company's financial and operational activities. What are the risks? What are the opportunities? So that includes assessing factors such as the market conditions, the industry trends, competitive positioning, matters like regulatory compliance, and also potential liabilities. Identifying risks and opportunities is one of the objectives of carrying out the financial due diligence assignment. 3 is to verify assets and liabilities. Verify assets and liabilities position. It's to identify assets and liabilities position. The auditor verifies the existence, the valuation, and ownership of the target company's assets and liabilities, including the tangible and the intangible assets, including inventories, accounts receivables, outstanding debt, fixed assets, and so on. That may involve conducting physical inspections. The auditor visits sites, visits to see with his own eyes the existence of assets. He verifies the documents to verify the ownership of the assets in order to confirm the accuracy and the completeness of the assets and liability positions. Verifying assets and liabilities position. The fourth objective of carrying out financial due diligence is to evaluate financial controls and systems. The auditor carries out financial due diligence in order to evaluate financial controls and systems. The auditor assesses the adequacy and the effectiveness of the target's financial controls, including internal controls over financial reporting, controls in relation to risk management practices, risk management practices. There could also be controls in relation to governance structures and so on. And that involves reviewing policies, reviewing procedures, reviewing internal audit reports. And the auditor does all that in order to identify any weaknesses and to identify any deficiencies that may impact financial performance, that may also impact compliance. Evaluating financial controls and systems is yet another objective of financial due diligence assignment. 5 is to assess financial projections. The auditor carries out financial due diligence in order to assess financial projections, in order to assess assumptions, and so on. You understand? To assess financial projections and assumptions. The auditor evaluates the reasonableness and also the reliability of the target company's financial projections and also assumptions, including revenue forecasts, expense projections, including things like capital expenditure items, projections, and so on. And that involves scrutinizing the underlying data, scrutinizing the methodologies, scrutinizing the key assumptions used in preparing projections in order to assess their accuracy and also their validity. Assessing financial projections and assumptions. That is the fifth objective. Six, lastly, is to provide recommendations and strategies. Another objective for carrying out financial due diligence is to provide recommendations and strategies. And these strategies could be mitigation strategies. Now, based on the findings of the due diligence review, after the auditor has carried out all this, he has assessed the financial health, has identified the risks and opportunities, has verified assets and liabilities, has evaluated financial controls and systems, has assessed financial projections and assumptions. Then the auditor is required to provide recommendations and mitigation strategies. The recommendations is based on the findings. These are the findings of the due diligence, the findings of the comprehensive review. And these recommendations are made by the auditor to the acquiring company or to the strategic planners or to investing party. Before you make a major strategic investment, you need to carry out a due diligence. So these recommendations are made to these parties who require this comprehensive review. And that may include identifying areas for improvement. The recommendations may identify areas for improvement for the company. The recommendation may also include the potential synergies, risk mitigation measures. The recommendations may include valuation adjustments in order to inform decision making and also negotiation processes. So the last objective of financial due diligence is to provide recommendations and strategies. Candidates were to give just 3. I've given you 6.